we're going to explore some really tough questions around things like how sustainable this AI boom really is and the escalating energy demands from it. Now, before we start here, if you haven't already, I'm going to encourage you to scan the QR code in the room. That's going to take you to a landing page. Most importantly, that's where you're going to find all the Wi-Fi information at the very top of the page. You'll also be able to join our community and plan your agenda. You'll find an icon there where you can download our events application. If you want to know who all is in the room today, connect and schedule meetings, that's where you're going to go. Just remember to use your email address that you use in order to subscribe to this event. There you're going to find our agenda. You'll be able to schedule all of the panel discussions that are most relevant to you and receive push notifications. If you want to make the most of your time today, you'll use that app. We want to hear from you today during all of the panels. There's going to be this little tab that you can click, and you can submit your questions that way. They'll flash up on the screen up here, and I promise that we'll get to as many as we can. You're going to find more information about our sponsors there. You'll, if you aren't already a Bloomberg.com subscriber reading all of our financial global news, shame on you. But you'll find a discounted subscription on that page so you can start reading right away. And if you use social media, please do post with the hashtag Bloomberg Invest. You'll be able to follow along to all of our live coverage at Bloomberg Live on most major platforms. Lastly, please silence your phones. And now we will begin. Nuclear energy has transitioned from serving a supporting role to really taking center stage of the AI revolution. And Helion Energy, backed by some notable investors, including Sam Altman, is trying to get the first commercial nuclear fusion power plant online in the world. And here to share the latest developments and his outlook on energy resources is Parag Jain, Chief Financial Officer of Helion Energy. Please help me welcome him to the stage. Parag, thank you so much for joining me. Everybody's dying to know, what is nuclear fusion?
Thank you for having me. So fusion is when particles come together to produce energy, exactly the opposite of fission, where you have particles splitting. Helion just approaches fusion in a very differentiated way. Super efficient, direct capture of charged particles. We do not use steam turbines. We're not capturing the heat to then turn it into steam to then move the turbines. We built 7 prototypes. We're on our final prototype today and are now racing towards commercial inflection.
You spoke a little bit about what fusion is, which is like the less scary, version of fission. And you talked a little bit about where you are in the milestone. Now, your timetable for bringing this first commercial power plant online is what I would describe an aggressive one in 2028.
That's right.
So how are you doing to hit that in-service date? And you talked about milestones. What are the other milestones that need to be hit to get there?
Absolutely. So as I mentioned, 7th and final prototype. I think the company has had a track record of relentless innovation. Each of those prototypes have broken multiple industry records. We have already broken ground in the state of Washington, in Malaga, Washington, received permits in record time, and so absolutely on track for first electrons on the grid in 2028. So fusion is no longer, something that always used to be the joke a couple of decades out. It's here and now. In the interim, we're going to continue to operate Polaris. We are starting to invest in supply chains. We're expanding our manufacturing footprint so that we can perpetuate and have commercial inflection, commercial scale in the very near distant future.
I ran our energy and commodities team before I was in the technology group, and the joke was that fusion was always going to be the next best thing.
Right.
That's your version of it. You were talking about supply chains, so maybe let's pause there for a second, because the supply chain around fusion must be a challenging one, as in it was non-existent. So tell me about some of the challenges that you all have faced in establishing a supply chain for a technology that wasn't there before, and like what needs to happen going forward to support that.
So we are building the industrial base for fusion today. We raised our Series F last year, $425 million. And the primary deployment of those proceeds, Lynn, was towards expanding our manufacturing footprint. For capacitors, we just across the street have now opened a facility that internally we call Omega, where we're exponentially increasing a capacitor production by a factor of over 10 times, which will, over the next couple of years, be 60 times as we further look to advance our manufacturing capabilities. Most importantly, we're also investing in our suppliers. So whether it's semiconductor chips, whether it's like all these specialized parts that you talked about, we're not waiting to start with our first commercial power plant and then invest. We're doing that today. The vision of our founders has been deployment of a gigawatt a day. Even back in 2014, when the AI boom wasn't there, the vision was always a gigawatt a day of deployment. And so we're putting in the foundation today so that we can move forward in the next couple of years.
Interesting. And sort of dovetailing with that is policy and regulation, right? Ensuring that there is like the incentive there. Now, when Helion Energy was first founded, the core mission was very much rooted in climate change and fighting global warming emissions with clean energy resources like fusion. Can't say that's top of mind for the current administration in the United States, but the AI boom is. So, like, how are you navigating the change in politics and instances on climate change?
Maybe I think the first thing that you touched on was regulation. I think that's something that we're pretty proud of, having invested in making and getting regulatory changes done years in advance. So today, we're not regulated by the Nuclear Regulatory Commission. The Nuclear Regulatory Commission has split fusion from fission. We're regulated as a particle accelerator. We're governed by the State Department of Health in the state of Washington, just like they do with university laboratories. And the key reason for that is fusion doesn't have the side effects of fission. There's no meltdown risk. There's no long-lived radioactive waste. And so we're seeing that when we first applied for siting and for permits in Malaga, Washington, for our first commercial fusion power plant. I think to your point, the administration is really supportive. If you really think about what are the impediments towards AI, at least in the Western world, we always compare ourselves to China, and we talk about energy dominance of China. I think we need energy dominance here. And to me, fusion is that perfect stepping stone, that new source of power that will allow us to continue to make all the progresses that AI and all the promises that AI has.
Okay, so we need fusion. I said 2028 was aggressive, and yet it's still like 2 years out.
Right.
So what are we going to do if energy is the bottleneck for the AI boom in the next 2 years before your first power plant comes online? What fills the void?
So today you do have, the demand for energy has increased quite dramatically, and you are seeing that being fulfilled by coal and by natural gas. That's why it's even more of a strategic imperative for fusion to have that calling and move as quickly as possible. And that's what, at least at Helion, we are working towards. There is no new source of energy outside of fusion that we expect, beyond 2028 to meet the demands of the AI boom that's coming up. Which is why, which is why even, the timelines that you call aggressive, they're required for us to be able to fulfill like the promise that AI has.
Yeah, and the timeline. Not that this is your problem, but then what happens to all of the gas and coal-fired power generation that is coming online now, being revived in order to power the data centers for AI today when your power plant and all the other fusion power plants come online?
So with any hard tech technology, and we were talking about like my prior company, it takes time for commercial scale and deployment. Our vision remains a gigawatt a day of deployment.
A day.
But manufacturing, supply chains will take a little bit longer. And in the interim, you'll have existing solutions that will continue to power the world.
Okay, that was a very diplomatic way of answering that question. Let's switch over to the funding environment.
Sure.
Because, Fusion was a small business, relatively speaking, for VCs. But now you've raised hundreds of millions, as you mentioned, just last year. Congratulations.
Thank
You
you.
have some big name backers. We mentioned Altman, but there's also Peter Thiel, Dustin Moskovitz. You're valued at more than $5 billion now. How has the environment changed for the industry and Helion? And what is it like working with Peter Thiel and Sam Altman as investors?
So when we started, there was no AI boom. And clearly you're seeing the tailwinds of that. And we see that every day. It's just the imperative to get as much power required out there for data centers, for hyperscalers, for electrification of the grid, electrification of several other industries. And so we're clearly seeing the tailwinds coming from that. To your question on, what was the other question?
How has the funding environment changed?
Funding environment. I think investors recognize companies that have a track record of fast timelines, capital efficiency, and relentless execution. And that's what Helion has been known for. You mentioned about timelines. We are moving fairly quickly. Relentless execution. We're on a 7th and final prototype. Capital efficiency. The company raised about $1 billion to date, but the 7 machines have taken only a fraction of that cost to put that together. And we're seeing that side effect when the Series F round that you mentioned, we were looking to raise $325 million last year. We had to upsize the round twice. We had over $1 billion in firm commitments. And so we feel fairly privileged that investors recognize the hard work that my colleagues and the founders are putting in so that we can bring Fusion to the world as quickly as possible.
And then there was my second question, which was, what is it like working with Peter Thiel and the likes of Sam Altman?
I think it is a privilege to be working. I'll give you both the company perspective and my perspective. I think what Sam, who's been our chairman of the board for over a decade at this point, has allowed is for the founders to dream a lot bigger, to move a lot faster from a timeline perspective. Clearly, he saw what the rest of the world is still catching up to when it came to AI. And so he's allowed us to move faster. He's enabled us to think and dream bigger. And I think that's something that we feel absolutely grateful for. Just personally working with him over the last 2 years since I've joined the company, I think there are 3 things that I've personally taken away. It's dream big, do not impose self-limits, and relentlessly execute. And if you have that trifecta, right, that's where the magic happens. And that's personally something that I aspire for on a daily basis when I'm leading my teams, when we're leading the company to move forward towards the timelines that we promised to the world.
That was really interesting insight. He does seem like a relentless leader from the outside. Does he text you every day? Like, are we there yet? Are we there yet? Like, is he, are they as involved at Helion as investors, or are they mostly just leaving you to it?
I think Sam's really good at guiding. Our investors are really good at guiding, but they make themselves available. So if I text him, I usually do get a response back fairly quickly. I think he is one of our biggest champions. And so for that, we're super grateful for everything that, whether it's Mithril Capital, Peter Thiel's a vehicle, or whether it's Sam, Dustin, and others who, have allowed us to be where we are today.
So I can imagine that OpenAI is a big potential customer for Helion, and you have a deal with Microsoft. Maybe you can talk a little bit about that agreement and what you see as like the ideal customers going forward for Helion's energy.
So hyperscalers like OpenAI, other large compute users.
Are we calling OpenAI a hyperscaler now?
Would be perfect, or big users of compute would be perfect customers for us. I have no additional customer announcements other than what we've already made today. But Microsoft and Nucor are folks that we've already signed up with. The first of its kind PPA was signed with Microsoft in 2023. That's Orion. That's where the construction of the first commercial power plant has commenced. We're going to put that power to the grid. Constellation Energy is serving as the power broker there. And the Microsoft data centers are just a mile north from our facility. That's for 2028. And then with Nucor, we have an energy development agreement for 500 megawatts for early 2030s. Nucor is the largest producer of steel in the U.S., and so, to us, it's both the hyperscalers, the big users of compute, but also the industrial power base that are perfect customers for the solution that Helion can provide.
Sure, that makes sense. And you talked a little bit about post 2028, what 2030s looks like for you demand wise. What does post 2028 look like for the company overall? Do you stay private forever? Do you IPO? Do you raise Series G, F, H, so on and so forth?
2028 is first electrons in the grid.
Yes.
That's when fusion comes to life. And then post that, I mentioned Nucor, which is 2030. And then, the vision of the company remains a gigawatt a day of deployment. Of course, we're going to inch up to that in lockstep and, not baby steps. We'll take big strides and big leaps, but that remains the vision of the company by mid to late 30s is a gigawatt a day of deployment. And so up until then, we're going to invest in our supply chains. We're going to continue to invest in a manufacturing footprint. We're going to continue to lay the foundations to honor that vision that the founders have, when they started with the company.
And then maybe a public listing, if you have time for it.
Yeah, I think from a capital perspective, we're so grateful for the privilege that we have, the strong conviction that our investors continue to bless us with. And so, nothing more to share there, but we're in a fairly privileged position that it would be our decision when and if, is the right time to whether to make that decision or not.
Okay. I promised everyone in the room that I would ask about the sustainability of this AI boom. There's been a lot of talk about an AI infrastructure bubble.
Mm-hmm.
We made a graphic that has gone viral now with lots of circles
right.
to show the circularity of AI deals. Like, does that keep you up at night? How worried are you as somebody who is all in on the infrastructure that's supporting this boom?
So if you look at history and if you look at technological trends, my personal conviction is we're still in the very early innings of where AI is going to head. The analogy a lot of times I use is think of like the internet, the dial-up internet back in the mid-90s to now, like, even post-COVID or during COVID, like where the internet went that allowed us to continue to move forward from an economic standpoint. And so we're still in the very early innings. I think the key blockers for AI used to be chips and power. The joke I used to make to investors is like, what will not prevent us to fully leverage AI's success were Jensen's chips and energy. Chips are no longer the bottleneck today. There's a lot of competition, and NVIDIA continues to do really well when it comes to providing the world with its supply of GPUs. Energy remains the bottleneck, and that's what we are working towards to provide that new source of power so that we unlock that bottleneck for AI to actually get to that ninth innings sooner rather than later. I believe we're still in the very early phases of the first innings when it comes to AI.
So if there is a bubble, you see it as being far, far out from where we are today.
Correct.
Okay. And, you have an interesting background that allows you to opine on sort of market conditions overall. Before this, you were at Waymo.
Mm-hmm.
And before that, you were in investment banking at Goldman Sachs and Morgan Stanley. I thought, personal question, what parallels do you draw between your experience both as an investment banker, but also at Waymo and your experience thus far at Helion?
I'll start with my last company, Waymo. When I joined Waymo, we were at that commercial inflection point. The company was pivoting from R&D to commercial roadmap. I think when I joined Helion, we're exactly at that inflection point. Everyone has started talking about Waymos today. That was not the case a couple of years ago. Everyone will start talking about Helion and fusion in the next couple of years. You're already starting to see the disruptive impact, the way that we think about travel. That's what Waymo is allowing that disruption to take place very soon as we think about where our energy is going to come. That's fusion, that's Helion in the next couple of years.
Great. Well, I want to also get your thoughts, because of your Goldman Sachs and Morgan Stanley experience, on this like recent AI fear trade. I mean, it just feels like, Anthropic particularly has become this like boogeyman, like everybody fears like what the next product they're going to release is and like which complex is going to tank on it. Like, how do you make sense of it as somebody who was in, on the other side of that trade at one point?
I think it takes time for the market to absorb and fully understand the implications of AI, and that's what we're currently seeing today. But I think the pace of innovation, the pace of disruption, the rate of change, the velocity is so much higher than what we had known in the past. And so you'll see some movements across different verticals and adjacencies. But at the end of each time we've seen such disruption, GDP has always pushed up higher. People have always ended up having better outcomes than where they were before. And so to me, I think this is just interim noise.
Yeah.
But we're seeing, we're soon hopefully going to gain the massive benefits and outcomes of this change of disruption that's taking place.
Yeah, what do you think? I mean, there is a contradiction, isn't there, between like, everybody who is saying that the AI is a bubble.
Right.
And everyone who's saying AI is going to be so extremely disruptive that it's going to destroy entire industries. Like, how do you make sense of those two seemingly contradictory, market reactions playing out at the same time? Or do you even try?
I mean, we're in Manhattan. I just took a cab from Central Park down here. But if you go back many decades, these streets were littered with horses. And so when, you had the cars first come up, people were talking about disruption of how, the disruption would cause to different industries. We've seen that with Industrial Revolution, and we've seen that with when internet came to fore. We're seeing that today with AI. To me, I think with each disruption, we have to adapt as a society, and I'm sure, we're going to prevail and do that again this time.
Well, we only have about a half a minute left, and so I'm just going to throw you a random projection question.
Sure.
Clean energy, zero emissions energy, I should put it, is like still only a fraction of the global power mix, a growing fraction though. Like if we're looking at 2050, what does the global power mix look like percentage-wise?
If you heard the president at the State of the Union, he's been talking about hyperscalers finding their own power solutions. I think to me, fusion, Helion, clean energy, being able to provide abundant, reliable baseload power is going to become a strategic imperative, especially for the Western world. And so to me, right, like it's no longer a question of like a nice to have, it's a must have. And so I see 2050 where like we have that clean, reliable, abundant energy available to all in an age of abundance, as opposed to, all the fears that we're currently sort of like.
So it'll make up like 90% then.
Maybe even higher.
Well, we've run out of time. Thank you so much for listening. Thank you for your time, Prime.
Great. Thanks so much, Lynn. Really appreciate it.
Please welcome to the stage Julie Solomon, partner and head of real estate at Ares Management Corporation, and Luke Taylor, co-president at Stone Peak Partners, for a conversation with Bloomberg's Tracy Alloway.
Thank you, everyone, for being here for day 2 of Bloomberg Invest. And we're going to be talking about one of the, I suppose, the topics du jour, which is the data center build out. But of course, when we think about real estate and private credit, it's not just about data centers. There's a lot of other stuff going on, believe it or not. So we're going to be talking about some of those opportunities as well with Luke of Stone Peak and Julie of Ares. So very exciting to be here. Luke, why don't we start with you? You actually started investing in data centers relatively early, even before the existence of ChatGPT and all the new platforms. What did you see in that space that perhaps others missed in, say, 2018?
Sure. Firstly, delighted to be here. So excited for the panel. So look, we invested in data centers 10 years ago. It's when we first started investing. And our view at the time is how do we get access to the data proliferation trends, but invest in it from the infrastructure perspective. And where we invested heavily in is what I call interconnection data centers or carrier hotels. And they're really the old telephone exchanges, so the network infrastructure that really connects all the network players
Those
together.
big windowless buildings that you see sometimes in New York, right?
Downtown Beverly Hills, downtown New York, prime real estate, but fantastic businesses. And our view is like society's getting more connected. We're changing the way we interact, and let's get ahead of that and invest in the infrastructure behind it.
So, Julie, one thing I kind of wonder is there's so much money going into data centers at the moment. Is there a crowding out effect when it comes to other real estate investment? Like, I guess that's a nice way of asking you, how jealous are you of Luke at the moment?
Very envious of you, Luke. But we do have a large data center business at Ares. We've been lending into the space for going on 12 years now. We've been buying data centers. We have our own development operating platform, too, that sits within our digital infrastructure business. And frankly, the growth and the attention around data centers is great for real estate and very much plays into what we've been talking about as new economy investors. What that means at Ares is that we are investing in the sectors that are benefiting from the fundamental changes in the way we live, in the way we consume, and the way we work. So the real estate sectors like logistics, multifamily, self-storage are very much benefiting from the growth in data centers because they're all so reliant on data consumption and distribution. So it's actually all playing very much together into the opportunity set for real assets as a whole.
Right, say more about how the growth in data centers would feed into something like logistics.
Sure. So if you think about the global logistics market and what are the drivers of demand of global logistics, you have shifting supply chains due to geopolitical factors. You have increase in e-commerce. E-commerce really only represents about 15% of retail sales right now. That's going to 35%. And if you think about just within e-commerce alone and the impact of data, and when you think about AI and the impact that that has, retailers everywhere are trying to increase conversions, so better ways to reach us as consumers. They want to have more efficient fulfillment centers, and then they want to figure out how to get those goods to all of us faster. AI is driving all of that. So there's a very clear impact of what data centers are providing, the infrastructure of how that then impacts logistics. Logistics buildings, also as an example, are typically in very well located proximity to large population centers. So with the increase in value of data centers, you can imagine the value impact that has on industrial assets as well.
Interesting. So, Luke, we're all trying to wrap our heads around how data centers actually work at the moment. But one thing I do know is that not all data centers are created equal. So talk to us a little bit more about where you're specializing and how you're trying to differentiate the business.
Yeah, great question. So given we've been in the space for a long time, we've seen how the whole data center market has evolved. You originally had the network connectivity assets. You've then had the cloud thematic. You've gone from the hyperscalers and now the AI thematic. Where we've really focused is continue to be around that connectivity thematic. As we went to large language model training, I guess our concern on a lot of that is what's the longevity? If you're investing in an asset, is it going to be there for 10, 15, 20 years? Or is your customer going to have completed its training and move somewhere else? And so we've invested more recently in the inferencing workload, and that's where the assets are closer to the network hubs, closer to the consumer. You're taking a bet on actually the consumer uptake on AI programs, which we think is pretty good. We use them a lot across our portfolio today. And you've got long-term contracts in place with very creditworthy hyperscalers. So that feels like a good spot to be in. And I'd say the other aspect to it is your valuation. So we tend to develop and build a lot of assets, which gets you in at a pretty good entry price, as opposed to paying a high price for a platform.
How are you thinking about, I guess, the pure hardware degradation side of things? Because one of the things we hear, especially on the training side, is, the data centers are going to run those chips so hot and so hard and so fast that they have to be replaced much more than, if they weren't doing training. Is that one of the reasons why you're moving more into inference as well?
That's right, but we don't really take risk on the hardware, right? That's ultimately the customer of the data center who's paying us.
It's still your cash flow, though.
Exactly, but that's why we view just the inferencing workload as much more durable, as opposed to the training, the chips are worn down, and then what's the next capital refresh of that?
And the other thing I'm very curious about is, I guess, correlation risk among the customers of the data centers, because you can imagine a situation where, okay, they're all very creditworthy, but maybe they're all SaaS companies who are about to get disrupted by AI. There's been a lot of discourse in the market about that recently. How do you ensure that the actual customer base is diversified enough?
So, that's exactly right. You want to make sure you've got a diversified customer base. You want, the big hyperscalers are very high credit quality, like the upper investment grade. If you're getting a long-term contract backing your facilities, you need to have that. I think it's harder if you've got a mix of customers which have lower credit quality about them. It's a key consideration.
You could almost say, right, that you'd rather have a smaller, higher quality cohort than a larger, more diversified pool of clients that you're working with that don't have that credit quality, given the long-term nature of these leases, right?
Spot on.
And this reminds me, but just in general, how competitive is the space at the moment? Because it feels like everyone is kind of fighting to get into these deals. When you're pitching yourself as a potential financer, how are you actually doing that, and how tough is that sales pitch?
Yeah, I would say, look, if you look at the hyperscalers today, they're under their leasing programs, right? So they're behind where they wanted to be. They're already leasing out 2028 space. Power connectivity is so key. Like that is the key to getting your offtake with your hyperscalers, having access to power. There's a variety of ways to do that. The grid is delayed in giving access, so you want to have a gas-fired solution as a temporary way to create power to your facilities. But that's the absolute key. If you've got the power, you're going to get the contract there.
And Julie, I'm just thinking back to the wider sort of new economy theme, but it feels like in the years immediately after the pandemic, it was a hot sector, kind of because people were looking for an inflation hedge and things like that. How much of that sales pitch has now flipped into an overall economic transformation story? Like, how much are people looking at this as, well, this is the future, we need to get on board, versus this is a cyclical play on potential inflationary economy?
It's a great point, Tracy, because what we actually have right now is the convergence of both, right? You have very strong structural demand drivers. They're just changes in the way we live our lives. And that relates to logistics. It's certainly being accelerated by all of data consumption. It relates to more flexibility that we want in our lifestyle. That's driving other types of real asset classes like multifamily, self-storage. If you're staying in multifamily, you still have the same number of products that you have. So you have these demand drivers that have really kicked up over the past few years. But you're now at a point where, following the rate hike that we went through, asset prices have effectively declined on average 20% plus. You have construction deliveries that have come down 50, 60, 70% in some sectors because of the cost of financing. And then you have more constructive capital markets. So you have also not just structural drivers around real estate fundamentals or real asset fundamentals, but you also have a cyclical opportunity here that's very strong. And that convergence is what we think sets up real assets for such a moment in time right now. But I would say it's not just a moment. When you think about a real asset or real estate cycle, it's many years long. And so we're just at the early innings of this. We're just past the inflection point of where the market has picked up. So we think it's a pretty exciting entry point that will create an opportunity for long term.
Actually, you just reminded me, you mentioned multifamily, so I have to ask about the state of multifamily because, of course, in some markets, especially the Sunbelt areas, the ones that went up quite a lot, we are seeing that drop right now. What's your take on just where we are in the cycle at the moment of multifamily?
Well, where we are right now is that we've been through a period of time since after the global financial crisis where housing stock has been undersupplied, right? We have an accessibility issue, we have an affordability issue that has persisted over many years now. So actually, supply has come down considerably while demand for multifamily product has only increased. Home ownership, home affordability is high. Flexible lifestyles are much more the preference right now amongst a larger renter cohort. And so you have really strong demand. What we faced over the past few years, particularly following the pandemic, was more supply that came into the market. It came into Sunbelt markets. At that time, Ares was actually monetizing a lot of our multifamily portfolios. That was a great decision that we made back then. But what we've now seen following the rate hike is there has been, in multi, at least a 50 to 60% decline in housing. It hasn't happened everywhere. Absorption has now really picked up. And so absorption is effectively now at levels that are above pre-pandemic. And that's the key. We need to see supply come down, moderate, and that's happening. It'll take some time in some of those Sunbelt markets, but that's where we always reinforce that real estate is such a local business. You got to understand the micro market and what's the dynamics within those locations.
And Luke, we should talk about energy and data centers. We were going to talk about this even before the events of the past few days, but if anything, it's more pressing. The thing you always hear, it's kind of become a cliche at this moment, is this idea that, well, the real constraint on the AI build out is on the energy side. How real is that statement? And then what can you do in your specific business to try to account for the energy needs of the AI build out in the data centers?
I'd say it's incredibly real. I think the new power projects in the queue are greater than the installed base of power capacity in North America at the moment. So that'll give you an extent of how much is trying to be built. I'd say at the moment, like, the constraints are a couple of things. The grid, just the age of the grid. The grid hasn't had any growth in power. You're now forecasting a big increase in power through the transmission line. So there's more infrastructure needs to be built around that. That takes some time. Just to go and get a new grid connection in almost 4 or 5 years in some jurisdictions for getting into the queue. And so the alternative is building your behind the fence power system, typically gas-fired. And so again, the constraint there is on supply chain, turbines. It takes a while to order the turbines, 3-4 years out from a supply chain perspective.
Well, people are still talking about a transformer shortage as well, right?
Exactly, all the key products going to the development of the power infrastructure. But we see a big thematic in that build out of behind the fence gas-fired power. The key there is having like dual fuel capabilities as well. So you've got the reliability for the hyperscalers. I'd say the other area too, which I think is pretty interesting, is the renewables, because renewables have been a bit beaten down. But if you think about what's the quickest way to get new power supply into the grid, it's building solar and wind. So we see that thematic continue, driven by what's happening from a AI demand perspective. And if you look at the next couple of years, there'll be more renewables built than the last 2 years, despite some of the volatility and the changes in the Inflation Reduction Act affecting that. So I think that's going to be a big thematic, all the power build out to support this. It's real, the crunch is there. That's the constraint to getting the hyperscalers there. They need to see the power, and there's a lot of capital going into build that at the moment.
And to your question earlier about the competitiveness of the space, you can see right there groups like Stonepeak, groups like Ares, who have that ability to see across the continuum of what's needed to actually serve your clients, not just from a capacity and a construction and infrastructure perspective, but from energy, the capabilities that you all have, that we all have. That's what provides an edge in this
sort of holistic view
in this competitive space, because there's so many dynamics at play.
Yeah. I mean, the other big thing that's happening on the data center side is we're starting to see some political pushback. It's very hard to pitch a story to voters of, well, your energy costs are potentially going to go up and you're going to lose your job. Congratulations. How are you thinking about that particular on the policy side?
Yeah, I think it's a real risk. It's well pointed out. What we're seeing is the data centers actually starting to bear more of that risk. And you've seen it play out recently in the last few months with some of the hyperscalers. Look, we're going to compensate that through what rate we pay for an industrial load. So therefore, making sure that power prices don't pick up on the actual consumers. So I think that's how that's going to be addressed, and we're seeing that real time.
And when you're thinking of data center deals, can you sort of rank the risk factors that you're considering? Is it like the quality and diversification of the customer base? Is it the energy needs are actually satisfied? Is it like, oh, wait, I don't want to actually invest in an area where there's a politician who's currently making noises about data centers? How are you ranking and thinking through those things?
Yeah, so I'd split the market into a couple of areas. I think the interconnection hubs I touched on earlier, like they're good investments. They're good in all the areas. They'll continue to be pretty strong through whatever the thematic is, particularly around the AI hyperscale thematic. I'd say when you rank it, like power connectivity is binary. Like if you don't have the power, you shouldn't be going into the investment, right? And you need a solution, and you need that redundancy as well of the power supply, because that's key to your off-taker. So that to me is a binary position if you're looking at a new facility you're going to build. Also then it's credit quality of the off-taker. What's the workload? Like large language model training versus inferencing. For us, there's a big difference in what's the longevity about that. We don't want to take a bet on who's winning the training race. And if I've got a 7-year contract, do I know they renew? If I'm in Nevada or West Texas, I could end up with an asset that probably has some obsolescence to it. So getting behind the right long-term thematic, which we think is the inferencing one, because we, as I said, we use it across our portfolio today. We see real-time benefits from AI that are having financial improvements in what we have. And so we think that's a great thematic. And then it's the duration of that cash flow you're getting. You're locked in a diversified, high credit quality tenant is key. And then valuation is absolutely key. Like, I'm not going to do that if I'm going to pay a high price for it. We'd rather build. And then you're at a pretty good valuation. So that's how I'd think about it.
Since you mentioned valuations and financing, that also reminded me that, again, this is a very eventful week and things seem to be changing very rapidly in markets. But if we do get a return of inflation and a rate cut from the Fed is off the table, what does that actually mean for the health of real assets?
I think first you want to contextualize where we are today, right? Which is we went through a period of very steep, very high rates. And for real assets, the asset class repriced. So if anything, we're in a pretty good position as far as entry point from valuations. And we really do believe that has settled out. The Fed has gone through a normalization cycle, which we're largely through. Would lower rates be beneficial to an extent? Yes. But I think what you actually see more than anything is that in this next chapter, whether rates move up, whether they stay where they are, whether they move down a little bit, the next chapter is going to be about driving cash flow growth, right? You're not going to be able to ride the momentum of the market. And that's where investing with managers who have capabilities to drive operations, to improve the actual quality of the asset, and are really sitting at the center of all these different dynamics, that's where the edge is going to be. So you have, in many regards, leases that have escalations in them going up by year that help address inflation. It's one of the beauties of being invested in real assets, and we think that where we are right now provides a constructive environment and actually keeps a lot of discipline in the market.
Luke?
Yeah, I totally agree with that. Look, I think it was hard to invest 4 or 5 years ago when rates were low. Like if you look at the real assets sort of spectrum of all the different sectors, you've got high inflation-linked assets, pricing power. Real assets generally perform pretty well when you've got high bouts of inflation. You've seen the higher interest rates play through, so the valuations are much more interesting today than what they've been for some time. So we've found it a pretty good investing environment from an entry price perspective. And then overlay the current market volatility. We tend to lean into volatility. Like you're buying assets which are long duration assets you're going to hold through the cycle. And so the best time to buy them is when there's a lot of volatility out there, because you're going to get a good entry price into those assets. And so we've found it a very good investing environment. Now you've got to pick your spots, right? There are assets which are overvalued, and you've seen the hype around hyperscale, but there's good ways to play it by building your own platforms. And we do a lot of that development and construction ourselves. So I think it's a very good investing environment at the moment.
You mentioned some things being overvalued. Obviously, we cannot have this conversation without talking about the actual supply outlook of the AI build-out and whether or not we are actually in a bubble. People feel strongly on either side. So you see some people argue that we're all going to become vibe coders, and the inference needs are going to be just ginormous in the coming years. And then you hear other people talk about, well, we're in .com bubble redux. I would love to hear from both of you, given that you've lived through many cycles in the real estate space, how you're thinking about that particular question.
I think from a starting point, and Luke talked about this early on, the demands to support not just AI, but just general computational initiatives that are underway, the demand for infrastructure is enormous. we don't believe that there is a bubble around the infrastructure needs. And that's why you need groups who are knowledgeable, who have the capabilities, who understand the impacts of the broader market and the energy needs to support that infrastructure. And so while there's a lot of discussion when you cast a very wide net around the industry, there are questions about individual companies, but the actual physical infrastructure needs, given the demands that we see that are going to be 300 to 500 times what we have today, if you look forward over a 5-year time period, are very significant.
Yeah, I agree. And it's totally different. Like .com was very speculative. It's not like people are building infrastructure with a hope that someone's going to use it. Like there is long-term commitments behind that infrastructure. But I just think of the anecdotes that we see across our own portfolio. We own over 50 or 60 different companies. We're seeing the benefit of AI. Like we're using it in terms of reducing costs from a call center and customer interaction. We've got another company where we do hundreds of thousands of customer interactions through different channels. The accuracy of that's about 80%, that interaction. We've been able to reduce the cost of that interaction by 2/3 and increase the accuracy to 100%. And so we're big believers in that thematic, and we're going through a global digitalization of everything we do, and the infrastructure there to support it feels really good at the moment.
Is there anything that would make you nervous in this space? Like, what are the actual signs that you're looking out for where you're thinking, okay, wait a second, maybe things are getting a little too exuberant?
I think, certainly, I mean, you've seen the valuations come in a bit with some of the recent sell-off, but I think the valuations were getting very toppy. Like large platforms were really prime valuations, which were hard to justify. So certainly, I think from a valuation perspective, to me, that's a little bit different to the demand perspective. They sort of two separate discussions. So I think that we had seen the valuations come up and then have come down. I do think on the demand, I think the risk is more around the training. And so do you have some of the hyperscalers saying, okay, well, I don't quite need these facilities because I'm training onto the next module, and do they sort of consolidate that? I feel like that's more where the risk is on the end market, as opposed to the inferencing, the workload, and the end consumer demand feels very good.
Julie?
Yeah. I would say with regard to the topic around AI and the build out of infrastructure around it, I think the concerns that Luke noted are the primary ones out there. Clearly, you want to make sure in any market, particularly when there's this much exuberance around it, that you have the right players, right? That you have the right groups that are out there that are providing the financing, that understand the risks, that there is appropriate liquidity when that's deemed necessary. And those are the types of items that we really focus on from a risk perspective. And then more broadly, there is a lot of volatility in the market, as we've talked about. That presents risks. It also presents opportunities. But you want to balance all of those views with how do those then make it through to the day-to-day consumer. And that's what we will all be focused on going forward. But right now, there hasn't been any clear evidence that has changed.
And Julie, you mentioned the infrastructure build out in general, and you hear these numbers, estimates thrown around of like what's actually needed in the US, and it's often in the billions, if not trillions of dollars. Is anyone talking about public-private partnerships at the moment, like the idea that maybe the government could step in and provide some of that capital? I feel like we go through waves where, it becomes a very big topic and then everyone forgets about it and it goes away and then it returns.
It's an interesting question because it certainly brings in, when you look at real assets more broadly, that the public sector has actually played an important role. And we've seen that in some of the asset classes that we participate in. We've invested in multifamily, for example, within the frameworks of local government policies. That's worked really well for us and helped serve a need for a particular city, for a particular region. I think more broadly, you always just need to take into account what are the political considerations, and in this environment, how is the government going to step in to take on that role? There's a lot to consider there.
Luke?
Yeah, I think we haven't seen a huge extent of it, but I think areas where the government can help with things like permitting and streamlining that, especially as the US wants to be the leader in AI, making sure we do get the infrastructure built in pulling back the constraints that actually build it, which tends to be a lot on the permitting side. So I think that's, if you're going to do something in coordination with the government, I think that's where they can be very impactful.
Does it feel like they're serious about making the permitting process a little bit easier?
It tends to get state to state.
Yeah.
That's often the challenge in the US, that like you have that overarching federal mandate, but a lot of the permitting's down to local permitting.
How bad is it actually? Because we hear these horror stories of, you know, projects that have been stuck in permitting for like 3 to 5 years.
We haven't found it too bad in data centers. I'd say it's more the getting the supply chain and the power is more of the constraint. But in terms of like local permitting to build a data center, you know, it's pretty streamlined. Again, it's state by state.
All right. Well, we only have a couple minutes left, so I want to ask both of you a sort of big picture, I guess, career-oriented question. But both of you have been through multiple cycles in the real asset industry, and you've seen large influxes of capital in the past, and you've gone through cycles where your own business has grown enormously and scaled up very, very fast. What's the one thing you've learned from previous, I guess, booms that you think is valuable in the current environment?
Well, I think with all these things, it's entry price. Don't get seduced by the thematic, and I think with it, it's like you'll play through the cycles. And I'd say the other thing is we lean into volatility. Like when there's volatility out there, play the long game. Like take advantage of it. But at the end of the day, getting into assets, long duration assets, it's all about that entry price and then what you can do to drive value over it. But I would say that's the thing. Like especially when I think about hyperscalers, it's easy to go, wow, it's a great growth thematic, and end up overpaying for it. Like you've got to be very, very disciplined in these markets.
I think it's a great point because especially when values have repriced, you can end up in second-tier markets. You could be coming at a lower entry price, and that could seem attractive, but it could just be cheap for a reason, and you aren't able to actually drive that cash flow. And I think what I've learned through investing across many cycles, many different environments now, it's all about driving to value creation. You can have a great entry point, but you need the capabilities, the skills, the people on the ground. You've heard us say throughout this discussion, local, right? It's about the local government, it's about the local population, it's meeting those needs, and understanding that within the real asset space is incredibly important, and that's why we've been constantly investing in our business to expand that capability set.
All right, Julie and Luke, thank you so much for a wonderful conversation, and thank you very much to the audience for being a great crowd. Thank you to our sponsors, Invesco QQQ. You are all free to leave this room and head up to some other exciting events that we have. So if you go upstairs to Hall 2, the program is continuing. We have the CEO of Temasek, Scott Kapnick, of course, and many others who are going to be talking about some of these topics and other things as well. So thank you so much.
Thank you. Thank you.
That was great. Thank you.
Thank you,
Thanks, Tracy.
Thank you.
So dance, we know the moves. The bow, the dip, the woo. Though the words are true, the state is old news. Wrap me in your arms, I can feel it burn. Rock me in your arms, I can feel it burn. Get up, get down, get up, get down. Feel the rotation start, see the next one waiting. Get up, get down, get up, get down, get up. Sentiments the same but the pair of feet change. I know my words will dry upon the skin, just like a name I remember hearing. Wild winters, warm coffee, mom's gone. Do you love me? Blazing summer, cold coffee, baby's gone. Do you love me? Wrap me in your arms, I can feel it burn. Rock me in your arms, I can feel it burn. Get up, get down, get up, get down. Feel the rotation start, see the next one waiting. Get up, get down, get up, get down, get up. Sentiments the same but the pair of feet change. Get up, get down, get up, get down. Feel the rotation start, see the next one waiting. Get up, get down, get up, get down, get up. Sentiments the same but the pair of feet change. I can't see the way you squint your eyes, pretend you're shy and look away from me. I hate it when the silence overcomes your smile. It's like you were just here, then you disappear for a while. But most of all, I hate the way you make me feel. Second guessing, is any of it real? Yeah, most of all, I hate I don't hate you at all. It's not your fault, I'm always there when you call. 'Cause you make me crazy, crazy, crazy for you. And it's so amazing, amazing, amazing what you make me do.
just to see you. Whoa, we're safe inside. You make things fine. Don't wait up. I'm okay, making time tonight just to see you. Whoa, we're safe inside. You make things right. Don't wait up. I'm okay, making time tonight just to see you. No, we're safe inside. You make things fine, so don't wait up. I'm okay, making time.
Private markets have become a defining feature of global finance.
I see a couple of people doing some dumb things.
AI is going to be so disruptive that it renders countless businesses obsolete.
I sincerely believe there is no bubble in the AI space.
We are in the midst of a rupture, not a transition.
We call him too late. He's too late. Jerome, too late, pal. He's too late.
Please welcome to the stage Bloomberg's Lisa Abramowitz.
Hello, good morning. Welcome to day 2 at Bloomberg Invest, a conference that increasingly is focused on the most important topic of the moment, aside from oil prices and what's going on in the Middle East, which is private credit. And we do want to focus and sharpen our focus on private credit and private markets more broadly in day 2 of Bloomberg Invest. Before we get to it, we had some amazing conversations yesterday with Apollo's Mark Rowan, as well as with Soros Fund Management CEO Don Fitzpatrick. Today we have an incredible lineup for you. We do have a couple of housekeeping issues to get through. We're going to just acknowledge first our sponsors. First, title sponsor Invesco QQQ, our knowledge sponsor Marsh, our supporting sponsors Allspring Global Investments, Deutsche Bank Wealth Management, Harborview Equity Partners, Moody's, and Salesforce. And for those of you in person today, if you haven't already done this, please scan this QR code. This code will take you to a landing page where you can find our Wi-Fi information toward the top, plan your agenda today with the community, and of course, you can, of course, also submit questions to our speakers. We will try to integrate them into the conversations as we can. If you have any issues whatsoever We, of course, have a help desk. You can please feel free to go discuss with them. You can find more information on our sponsors here. And if you don't already, please subscribe to Bloomberg.com and all our global finance coverage. Today is your lucky day if you want to do so, because you can get a discounted subscription. And if you are active on social media, use hashtag Bloomberg Invest in your posts, and you can follow along with all of our coverage at Bloomberg Live on all of the major platforms. Please also, lastly, silence your phones, as we do have an incredible lineup, which I want to say starts off with someone who is one of the behemoths in private markets, one of the behemoths, frankly, in world investing. I want to welcome to the stage someone who has really shaped the way that private investing has taken shape over the past 15 years. It is the Temasek Holding CEO, Delon Play.
Thank you. Morning.
As I said, this is a massive fund. As of the fiscal year that ended last March, so I'm not going to say what happened for this year, they have $340 billion of assets under management. Delon Play has overseen this fund as it has changed pretty significantly from back in 2011, primarily being an investor in Singapore assets, today being very different. Could you just, before we get into some of the current events and what's been going on in markets, just give us a sense of that transformation that you've seen?
So actually, the transformation done by my predecessor, Ho Ching, and she was brought into Temasek to make us more of a global investor. When she first came on board, 97% of our assets were Singaporean companies. And by the way, we own our assets; we don't manage it for anyone. By 2011, we had made it such as about something like about 56%. And today, Singapore assets are just 41% of our total net asset value. And so that transformation that's been done over the last, I would say, 20 years has been predicated on investing in global markets. We first started in Asia in the first decade of the 2000s, and then in the second decade, more into the US and Europe, because we felt that a balance between developed markets and emerging markets was required. We also started to increase our allocation into funds and asset management platforms that we set up. And so today, we have a fairly balanced portfolio, which is 41% the Singapore companies that we control, roughly about $150 billion of revenue that's either consolidated with balance sheet or of companies that we control with significant minority stakes. 30% is in global investments all over the world. And the balance of 23% is in funds, asset management companies, and partnerships that we have with either financial institutions or corporates. So it's fairly balanced, I would say.
And you were speaking before, and you were saying about half of the fund is liquid, and half of the fund is illiquid in private markets. As we sit here today, the world feels very dynamic. We were thinking about AI disruption. Now we're thinking about an oil shock that could potentially send inflation spiraling. As someone who tries to toggle between private and public, liquid and illiquid, how do you think about catalysts that seem to be coming at us increasingly frequently?
Yeah, that's a good question. So if I were to go back to 2011, we were 80% liquid, 20% illiquid. By the end of the decade, we were sort of like 55% illiquid, 45% liquid. Today, we're about half and half. So 50% is in liquid, 50% is not liquid. If you look at this chart here, you will find that we're primarily an equities house. So you take away the private credit at 2%, core plus infrastructure at 1%, 97% is in equities. And it's 48% liquid and 49% illiquid. So it's a balanced portfolio. Now, why is it that we went into private markets? In a low interest rate environment in the past decade, you could actually argue that you could earn the illiquidity premium within a reasonable time frame. So in the previous decade, time to monetization through public markets within 5 years. It then went to 8 years. Today, you're looking at past even a decade. So the question for us today is whether you will get the illiquidity premium in a higher interest rate environment. So that's why we've decided to put a little bit more capital into liquid strategies. That includes public markets, investing indices, and things like that. Because we feel that in a world where there are more surprises, shocks coming more frequently, disruptions like AI this time around, it is important to have enough liquidity to be able to pivot, change strategies, pivot, decide where you're going to put your chips for the longer term, or even rebalance for the shorter term. And so as a result of that, we've decided that we should maintain a certain level of liquidity in our portfolio, because we do think there's a premium in being liquid today. That's our view.
So, and I want to get into just how much you are planning to continue to increase the liquid versus the illiquid part of your portfolio. I mean, is that significant in terms of how much more you have to go?
No, I think we're there. I think for now, for every dollar we invest, we're not going to do it in a programmatic way, but I think it would end up being sort of 50-50. You know, some years that may be a little bit more because of opportunity, some years a little bit less, but we'll make sure in the long run we maintain that balance.
We'll get into the private side of things, but before we leave this, I want to get your thoughts then on how you respond and be dynamic in the face of a potential oil shock, since that's the latest catalyst in addition to AI disruption and credit fears that seems to be targeting investors. Do you respond to that? Does it make you pivot?
You know, things like oil shocks, we've had to live with it for a long time, and parts of our portfolio will be impacted by it. For example, we own an airline. By the way, for those of you who fly regularly, please consider our airline. You know, whenever you have something like this, what's going on in the Middle East, straight away, even though the Middle East is a small portion of the revenues, people think about the potential of increased oil prices on your P&L. People might travel less because of conflict and things like that. Every time there's something like the avian flu, your airline gets impacted by share price, so everything gets impacted if you own an airline. Like, look, you know, some parts of our portfolio clearly will be impacted by rising oil prices. You know, power generation companies which have inputs from natural gas and things like that. But the bulk of our portfolio is not. It's quite inoculated from the impact of oil prices. Obviously, for the financial services sector, it's a proxy to the broader economy, so that part of it gets impacted. But we've got a fairly balanced portfolio. So I'm less concerned.
When you talk about the 50% that is in private markets, I just wonder how much, you said 2% is in private credit, how closely you're watching what has percolated out that people see potentially deepening, really the epicenter right now, BDCs, private credit funds tied to software.
Yeah. So first of all, I would say that private credit is a relatively new part of our portfolio. You know, we've always been investing in it for the last, I would say, 20 years, but we started to ramp up about 10 years ago. So the 2% of our portfolio value, which is roughly about $7 billion US, it's really something that we built in the last 10 years. We have a separate entity, a credit hybrid solutions entity that we spun out as a wholly owned subsidiary. And that has a very clear mandate, you know, get us something like a 5 to 6% cash yield on an annual basis, a total return of maybe, you know, low double digits, 11 to 13% with a leverage cap and a cap on PIK because we want the cash yield. And with that mandate, they've managed to do quite well. The credit quality is keeping up. Besides that, we have investments in funds with people that we believe are best in class. You know, so far, they're holding up. So it's really a question of manager selection, the kind of the part of the credit sector that you want to put your money with, and then you take. You have to figure out whether, you know, the asset quality is there, whether the fund managers are doing what they're doing. And so far, you know, I'm not as concerned with our credit portfolio.
So there are two ways to ask this. First of all, it's only 2% of your portfolio, so it's pretty small. You address the one of how is your portfolio managing through this. The other way of saying this is, at what point do you get excited about where you can potentially expand and get involved if there is dislocation?
So that's always the exciting part, isn't it? Because if you can get in cheaper, that's the best way to make returns. You know, it's all a question of the entry-level price. So when there's a lot of froth in the market, you take on more risk. It's more expensive to get the returns that you want. So the question for us, you see, you still have to go back to the question of asset quality and the pricing for the asset quality, right? And so I think that there will be opportunities for us to partner with the funds that we are invested in to look at those opportunities at the right time. You know, you have to, it's opportunistic, okay? It's opportunistic. And it's not going to be a major part of our portfolio. We're still going to be equities focused, right? So maybe private credit can go up to 5% of our portfolio over the long run. But we don't want to change the DNA of the firm. You know, it's primarily equities firm. Now, why do we do private credit? Well, it's simple. It's a little bit of a diversifier from our equities exposure. It gets us up the capital stack compared to where we normally would be. But the most important thing is it gives you market signals of what could happen in the equities piece of your capital structure. You know, so that's what we look for.
What's the signal right now?
You know, certain asset classes or certain sectors that we're invested in, we've got to be very careful about looking at the balance sheets of those companies and what it means in this in the cycle today, and whether the cash flows they're underwriting are going to be strong enough, to withstand volatility or shocks in the system.
Shocks in the system is one thing. Disruption as a
Disruption
result
is a big
of the
part
new
of it.
technology. So
Yeah.
how do you identify who's prone to it, whether the software shock is really specific names that are going to go to zero and others that are going to be incredibly successful, or some kind of widespread replacement?
So I think, with what we've seen in the last few months, things that you didn't think would be disrupted are becoming disrupted, or at least the perception of disruption is very high. And so you now have to think about other things that you're investing in and what is the likelihood of disruption, because today the reality is that disruption may come sooner than you've expected before. And therefore, to what extent are companies prepared for that? Now, I would say the counterbalancing to AI disruption is AI adoption. So if you have companies that can adopt AI to accentuate their business models and be able to not just withstand the shock of disruption, but actually thrive in it, that's the most important thing that we look for. And that's what we're doing today through our portfolio.
Are there certain types of companies that seem like they are able to take advantage of this disruption versus just those that are looking to potentially survive through it?
Yeah, so look, even with software companies, right, which are in the news all the time, if you're mission critical and you know how to use it to actually accentuate your product offering, it's a good place to be in, because no matter what, we're still going to need software. It's not like AI is going to take over and the entire software sector is going to dissipate. But you've got to make sure you can pick the right companies to invest in. I think that AI is going to have a profound impact on sectors like pharma, biotech, drug discovery, drug development. I think it's going to have a profound effect. And so those companies that partner with for AI solutions are going to be a beneficiary. The question is just when. It's a highly regulated sector, so a lot of things have to happen for you to see the full benefit of AI adoption.
So you're talking about how things are pretty dynamic, and these are things you can't know right away. And so that's one of the reasons why you want to have a bigger proportion of your portfolio in liquid versus private companies or illiquid. Can you give us a sense of which companies you'd rather own in your liquid versus illiquid? Is there a certain type of asset class or a certain type of industry?
Yeah. So look, you got to, when you look at liquid, you got to figure out which part of your portfolio is really for the longer term, and that's compounding. So you got to look for companies that you feel can be compounded. Some of the Mag 7, you can take the view you can compound for a long period of time. If they keep innovating at the pace that they're innovating. There are other companies which we feel in the deep tech sector, et cetera, that could also be compounding. You look at where the choke points are and demand versus supply, and you can figure out that some of these companies could be companies owned for 10 years in the public markets. There is going to be more convergence between AI and climate adoption, climate tech adoption. Okay, and I think that that's what's going to help with climate change transition for many of us. And I think that that's exciting for us to look at and see which companies will be prime beneficiaries of that. So there are many different sectors where you can look at it differently now because of AI.
You talk about returns, and you've delivered some pretty significant returns investing in private markets over the years. And I just wonder, you expect bigger returns for taking bigger risk. And there are times that feel like a better time to take more risk and times when maybe not so much. How do you characterize the moment we're in right now?
So I think it's probably the most trying time to be a long-term investor. It really is, because if you're trying to invest for the long term, you're trying to invest through market cycles, and nowadays with the disruptive forces out there, what exactly is the cycle for your business model? Are you continually transforming your business model for that? And I think a lot of it depends on the industry, the company, the cycle of management, and things like that. Even we as a shareholder, an investor, pushing for companies to continue to always be on the edge of transformation. And I think that is the biggest issue for us, as a long-term investor. So if I look at what concerns us as a long-term investor, or what's on the horizon for us, first of all, is geopolitics. It does impact. Secondly, is geoeconomics. What happens for the US dollar does impact our returns, for example. The third would be technology. Both but not just in disruption, but how do you use technology to actually improve things, not just in business, but in the world. And finally, the investment strategies that take all these things into account. So, in that sense, 10 years ago, we didn't have to think so much about geopolitics. Geoeconomics are fairly stable. Technology disruption was identifiable. And then finally, your investment strategies are pretty much linear. Today, it doesn't happen that way anymore, I think.
So, talking about geopolitics, do you think that people are overly sanguine right now in markets about the geopolitical risks?
I think the market has taken a view that some shocks can be shorter in duration than otherwise, and so therefore they are pricing the risk, but they feel in the longer run, you might be able to get around the risk and still be all right. I'm not smart enough to know whether that's the right thing to do or not. I'll just watch and see where we put our funds to work. But I do think that there is a certain amount of, I think the market's relatively sanguine with everything that we're seeing. And let's face it, right? I mean, since what's been happening in the Middle East, the markets really haven't moved down that much. S&P is down, 1.5, 1.6%. Our financial year is 31st of March. What happened 2nd April last year? And you saw with the way market moved down. Thankfully, our financial year is 31st of March. Or thankfully the Liberation Day happened on 2nd April. Anyway, this time around, I've still got 27 days to go for our financial year to close. It's better to look out 5 months down the road because something had happened to turn it around. 27 days is interesting. So let's see. Yeah.
I want to finish up on dollar exposure because.
But can I just add something? You see, we're allowed by our shareholder, and shareholder doesn't get involved in our business at all, to take more risks because we're an equities investor. So we're high on the risk. I would say on the risk curve, and our threshold for pain therefore has to be higher. And so the requirements for returns are therefore much more than what would be required for a sovereign wealth fund. So that puts you also a little bit more on edge, right? Because you have a responsibility of trying to deliver those outsized returns. And in inflation adjusted world where interest rates are higher and possibly higher for longer, we should expect to get those higher returns. So we have to put that on ourselves.
Yeah, so you notice some of the risks out there. I do want to finish up with the risk of the dollar because about half of your portfolio, I believe, is exposed to the dollar.
Directly 41%.
41%. So I'm just curious how you're hedging. Are you planning to reduce exposure to the dollar in order to avoid some of the fluctuations, or are you going to double down?
So the most trying time was the second quarter last calendar year, when the dollar began to depreciate significantly against the Singapore dollar. And Singapore dollar is our reference currency. And in any event, 50% of our exposure is in Singapore dollars. So it moved, I think, almost 5 or 6% during that time. It's about 7% down year on year. But it went up a little bit in the last few days. So that just tells you that the dollar is truly, the currency you go into in times of risk. So what we tried to do then was we figured, okay, we'll hedge part of the dollar-denominated portfolio, which we did, a significant amount, I would say. And the cost was fair, was okay. But as we got along, everybody else had the same idea. People were not rotating out of US dollar-denominated assets, they were hedging for returns. And the hedging costs went up to, 2.5, 2.6%. So today, the cost of hedging doesn't make sense unless it's tactical for a shorter period of time. And so we now have to basically put in place what we will call natural hedges, which really means you have to invest in things that will give you a return that outpaces expected dollar depreciation. But, the events of the last few days reminds us that the US dollar is still, the global currency of choice, reserve. It's not just a reserve currency, it's a safe haven currency for many things that happen in geopolitics and what happens in the world. And so I think we've got a good balance, I would say. The dollar has strengthened. The policy of the Treasury Department is to have a strong dollar. So in that sense, would that change anything that we're doing? The answer is no. We'll continue to invest significantly in US and US dollar denominated assets.
Well, there is so much more that I want to ask you, but unfortunately we have run out of time. Dilan Pillay of Temasek, thank you so much for being with us.
Thank you.
Today.
think with our combined platform, we're better positioned than ever to be a high-grade solutions provider.
Please welcome to the stage Scott Kaplan, founding partner and CEO at HPS Investment Partners and chairman of the Private Financing Solutions Executive Office at BlackRock, for a conversation with Bloomberg's Stanley Berger.
Thank you all so much for joining us this morning. And Scott, thank you so much for sitting down with me.
Thank you. Good morning.
We're in a moment that feels very pivotal for this market. And I think it's useful to just take a beat because in many ways your career reflects the entire journey that this market has gone on. Heading up the investment bank at Goldman, spinning out HPS from JP Morgan, bringing that back under the fold of another company, BlackRock. Scott, how did we even get to this moment, though, where private credit became the behemoth, the headline grabber that it is today?
Right. Well, good morning, and thank you for having us. And you know, we're living in a moment right now where maybe one of the most significant events in the world for the last 50 years is happening while we're also talking about private credit. So it's a little bit hard to put that into perspective. But I think you know, what's from my perspective, again, 40 years in finance. Been all over the world with Goldman and JP, and you know, the Western capital markets are going through a real change and evolution now. As you've had sort of the post-financial crisis landscape really settle in, banks have shrunk. You've got some big banks still very involved in the capital markets. You've got some big, some of the people that were on stage here over the last couple of days. You know, insurance companies and others, and then you've got some fiduciary firms like ourselves and BlackRock and Ares was on stage. You know, those firms are really bringing private pools of capital to grow companies, and with that, there's not enough bank capital in the world to grow the economy, and particularly as governments have leveraged themselves, there's really just not enough capital to grow the economy, and I think you're going to see that. Wave has been very big in the U.S., very big in Europe, parts of Asia, Australia. I think that's going to continue over the next 30 to 50 years. It's
a good point because not only are governments very levered at the moment, there are these huge projects that they're undertaking, whether it be Europe wanting to be more self-reliant, be it the AI build-out in the United States. So just how critical of a pillar has private credit, has private capital become for these economies?
Yeah, I think that, you know, again, they're not with the capital expenditure that's going into both technology, AI, as well as the underlying infrastructure. You're not going to be able to do that without private pools of capital. And Dylan, who you just spoke to, is one of the smartest and most aggressive in that. And I think you know, you've got to have people pull that together and help structure things in a way that optimize and make it efficient. You know, so you want equity in that. In order to attract foreign direct investment, you need the capital that comes alongside the equity to help that.
You made the comment to me the other day that I thought was interesting, that not only is this change continuing, but the pace is accelerating. What does that mean if we zoom out 5 years from now? If the pace continues to accelerate, what does this market look like?
Other than our heads explode?
Yeah, that's possible too.
No, I think that we are in a period where change is really evolving quickly, and I think that with what's coming with AI, and I know Larry Fink and Rob Goldstein wrote an article on tokenization and the impact of that. That's also going to change financial structure as well as technological evolution. So all of that is going to come here in the next few years. Most of the financial landscape was set up really after, 1929, 33, 34 Act. Banks in the U.S. and the West formed around those structures, and a lot of the technological change it has the potential to really change that dramatically.
Well, as we laid out, you've invested in many moments of disruption, be it Goldman at the dot-com boom and bust, be it JP Morgan and HPS during the financial crisis. This moment of change right now, does it compare to the scale of those disruptions?
I think one thing you learn is every disruption is different. I think a few of the things that you have to watch, again, I was in Germany in 1990, so the wall fell in 89, 90, and then as you get into the 1999 buildup for the dot-com and then into the financial crisis as with part of JP Morgan, leverage in the system, you have to watch that. We've been very conservative with leverage in what we're doing. I think, those are themes that come out. Matching assets and liabilities and matching structures so that you don't have a liquidity mismatch. I do think what's different today, the banks are I think, very healthy. You heard Jamie Dimon, you hear other bankers talk. I think the banks have remade themselves after the financial crisis. Obviously, we recapitalized the banks in the U.S. In Europe, they've shrunk a bit. But they're very healthy, so that's a positive sign. And then I think the CapEx cycle that you mentioned is something that has put the economy in pretty good shape here. So if we are going into a period of disruption, I think those two things are at least positive to keep.
So where do the concerns of leverage in the system come from then?
Well, I think that a lot of the leverage has moved to governments. So you've seen Scott Bessent and others try to really make sure that we're growing the economy and that the world is growing to keep pace with that. And then you've seen the labor dislocation that may come out of technology. We don't know where that'll go. That creates political upheaval and can rattle financial markets. Right now, I think the financial markets are behaving, some would say pretty surprisingly, how we're managing through what is a pretty significant turmoil, obviously, in the Middle East.
Jamie Dimon, though, you mentioned them. He did say, along with the health of JP Morgan, he's worried about others seeing risky lending that echoes back to pre-2008. Do you not see any of that then?
No, I would agree with it. I would say, listen, Jamie has been a close friend and one of the best mentors and leaders I've seen. And I think whenever you see things, you want to tell your organization to look closer, make sure you're very disciplined, be a good fiduciary, be a good risk manager, and we all will have our moments. Everybody that has spoken at this conference will have their moments, and you just have to make sure that you're doing it better than the others, and trying to show the dispersion that will come out when you do have those cycles.
I guess what I'm trying to understand is if there is a disruption, where it comes from. Is it from government then, because they're over-levered?
Well, I think that for what we do, I think obviously private credit there has grown significantly. So we've grown from like 300 billion back when I first started, maybe in the 90s, to now 2 trillion, and I know Mark Rowan was quoting more like 40 trillion if you include all the private high grade. Anytime you have an industry that grows like that, there will be pockets where things are more difficult. I think that the areas that we're watching are smaller companies in the U.S. in particular. So if they're smaller companies, it's harder to deal with tariffs, it's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that creditors or lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software, really in the 21-22 vintage that was pretty highly priced, and that as that works its way through the system now 4 or 5 years in, you may see pockets there. But I also think that the need for income, people want income in their portfolio, and they can get that in many ways. You can get that from the treasury market, you can get that from a bank, you can get that from high yield right now is pretty good. High yield has very little exposure to software. And then you can get it from private credit, where you maybe get more return and a little less liquidity. And so that, I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
There have been some, and Bruce Richards among them from Marathon, now part of CVC, who will be speaking at this conference, saying that the issues with software harkens back to 2016, what happened in energy markets, that oil prices go negative, energy credit is an issue, and it has a wider spillover effect. If there is an issue with software and you start to see defaults pick up, are you concerned that it might have wider ripple effects, or do you see it as very confined to the sector?
Well, I think the comparison to energy is a little different, right? You had a commodity risk that is very hard to hedge. So we don't do a lot of commodity lending.
Sure.
And that's a different business, really, and a different risk profile. I think on the software side, you will see, again, same themes, smaller companies, models that are easier for AI to disintermediate will struggle. Obviously, every owner of a software company will try to morph that. So I think it'll be more dispersed amongst managers. Some will have done more. And again, it may be as private credit was growing during that 21-22 period. There was a lot of activity. People were trying to grow their businesses, and there now may have some of those loans that they have to make sure are going to become due. And if they struggle, then those firms are going to struggle.
So if the pockets of weakness are smaller, mid-cap companies and software, does that have any other economic ramifications? I think especially of small companies in America being the biggest hirers among the population. If those are the ones that are in trouble, is that a problem for wider American markets and economies?
I think the pace of technological improvement and the productivity improvements feel like the U.S. economy is going to grow its way through this. And obviously, you may have pockets of labor dislocation that will be hard politically, and we all have to work to make sure. In my career, again, over 40 years, I've seen as we get more technology, we need more engineers, we need more people to do more things, and I think I still am cautiously optimistic that we're going to work our way in that direction. But it's certainly a big technological change, bigger than anything I think we've experienced.
So if it's a moment of disruption, the pace of change is accelerating, be it technology or Western capital markets. When there's dislocation, there's opportunity. Where are you finding that opportunity right now?
Well, I think the interesting thing, and with some of this change, there has been some volatility. You've seen it in the equity market pockets and in the credit markets, where maybe because of some of the concern, the opportunity set is getting better. We've spent really the better part of 17 years being pretty conservative, tried to stay low leveraged, and so in a moment where maybe there is some dispersion, that's going to create opportunity. I think we see opportunity for the bigger players. So part of BlackRock now, being a scaled player, we're running a business now about $400 billion of capital across a variety of different lending activities or financial activities. And in that, we're seeing both borrowers and LPs want to work with partners that can be reliable, where you can be fast with capital, you can commit to them, you can deal with complexity. And then on the LP side, they want to see, we're fortunate to have a variety of different places where we can show them, this is your risk return, this is what we have in high yield, this is what we have in private credit, this is what we have in solutions, and you can bundle that in a portfolio that makes sense. And I think those trends are accelerating.
What then happens to middle market players who not only can't participate in that, but have lent to the smaller companies that, as you say, might have issues?
I think there will, as there always are, there will be middle market players who do very well. And then broadly, if your business, again, in credit, what we've always wanted to have a very wide funnel. So half of our business is non-sponsor, half is sponsor. Most of the middle market players and a lot of the players focus only on sponsor lending. So that limits them to sort of, and when they're just doing what they see, that creates a little bit of a problem. If I'm just doing middle market and then middle market goes bad, that's likely to not go well for the portfolio. If I'm just doing software lending and that goes bad. So I think you really want, and people like Mike Milken and others have talked extensively about portfolio construction, conservative building of the portfolios. That's what's going to carry the day.
So you mentioned the integration now into BlackRock, getting that scale, announced late 2024, finished July 2025. How has that gone? What has integration been like?
Well, where we left the other day, I think Mike Patterson and Scott French and I were saying we've worked as hard as we're ever working. So, you know, coming into a big organization is very exciting. I think, as I said at the beginning, BlackRock's footprint, and one of the things we wanted to get out of it was really the origination opportunity with everyone. And I had this a little bit at Goldman and JP, where we now, when any borrower in the world should want to talk to us about what can we do, that's working. That's taken a lot to, you know, really get going. And I think we're just in the early innings of that driving. I do think, and I think somebody might have said this on stage yesterday, the shortage is origination in these businesses, finding good assets and then being able to structure them and deliver them into managed accounts for LPs in a way that they have low single name risk. So that part's been good. And then what we've done with creating a $400 billion boutique within BlackRock, if you will, I actually think we've streamlined it. Like sometimes in business, you take big things and put them together and simplify it. And I think we've really simplified it for both borrowers and our LPs in a way that, but it's been work, and it's going to continue to be, you know, a fair amount of work, but very excited about it.
How do you see the existing BlackRock credit business? Because it does feel very different than yours. More middle market, mid cap companies versus, as you say, the split you have tends to be more kind of large cap.
Right.
How do you make sure that you can meld the two? How are you thinking about that?
There's been very little, overlap. I think in the middle market business in the U.S., I think there's been a little bit of overlap, and again, that's been a business with the companies growing less quick that you have to really be very disciplined right now. So we've been doing that, and I feel good about the team. Mike Patterson, Vikas Kaswani have done a great job, you know, trying to streamline and integrate that. In Europe, they had a middle market business that was pretty standalone and was very, very successful. I think that is also then people are able to say, hey, if I've got a bigger deal, you know, I'm mining for my middle market. If I get a bigger deal, I get to do that. That gets to be positive, and you get those positive benefits of having many different pieces of business together. So
I do just have to ask, because there was one of the BlackRock funds, one of the BDCs that was marked down 19% to NAV. Again, a legacy fund, not one that you brought in. How are you managing that right now?
I think that there are pockets where you have to take a look at what the portfolios are and really take a look at, you know, what how to continue to evolve there. That's a traded BDC. Right. So a lot of people don't know the difference. Some are traded public but non-traded, and then that's a traded BDC. So what you're talking about there is the portfolio took a mark, and then the shares are traded in the open market. And, you know, you just have to be a good fiduciary and a good risk manager. And in that one, we're trying to help continue to drive what's right for both the borrowers and for the investors.
By the way, I did do my homework. HLend, which is a non-traded BDC, you had your marks at the end of this year.
Yes.
And staying very steady there, marked on only 5 cents, very, very negligible. There have been other BDCs, though, that have reported that have seen some discounts to NAV. Is what we're seeing now, when you're talking about the risk management, is it signs of stress, or is it just a return to historical norm after a period of low rates and maybe easier returns?
Yeah, I think you're hitting on something that is hard for the press and hard for media to really understand. When, you know, you see defaults, you see things happen. We were in a period of very low defaults during when interest rates were very low during COVID. Coming out of that, you are returning to normal and getting to more of a 3.5–4% default rate. Again, what matters in credit is not defaults, it's losses. We've had a very good history and track record of doing that, of building big portfolios with very low losses, and we're super proud of the business we built. And again, I think as we see more dispersion, we're going to show how that performance and how that fiduciary focus, risk focus, low leverage will hopefully shine.
Sometimes, though, returning to the mean can feel painful for people who got used to lower rates, especially as the industry starts to push into retail. Do those two projects come into conflict with each other, of trying to bring more outside capital in at a time that, yes, it's just a return to the norm, but you start to see defaults pick up?
Right. Well, you mentioned Jamie. I mean, Jamie did say, anybody can make a loan. Not everybody that makes loans will go well. That's true. We also have a group that focuses on, and if loans do go bad, we need to be able to go in and take over the company, be able to manage that to optimize the return. Not every firm has that. Not every firm has the scale to afford that or the talent to do that. And I think that's something that will differentiate people. If you're just saying, okay, I'm out, then you're going to have much larger losses, and that's not going to be good.
It feels like just even more consolidation, Scott. If you have companies, if we remember the mid-cap players, you said, yes, some of them will do well, but maybe they don't have the teams to take back the keys. They're already dealing with companies that are under stress. The consolidation that's underway, just how dramatic are we going to see this evolve over the next 5 years, let's say?
Well, it'll depend on performance, right?
True.
I think that back to what you were saying too, there were periods where I mentioned 21 and 22 where software was very hot, firms were growing their business and wanting to lean in, and there is a little bit of okay, we wanted to grow. I think most of the big managers are very good at managing risk, and the scaled players are going to continue to benefit from this period. I think when you have less scale and you're doing more niche-y, what do I see? I'm only seeing a limited thing. That's a tougher spot to be, and I think those players will struggle. But again, they can have a business that's small. It's not going to be what I was talking about in change, the restructuring the capital markets and big pools of capital. It's a different game that they're playing.
Scott, I'm afraid we are going to have to end it there. Thank you so much for joining. This was a beyond fascinating conversation. Everyone, please join me in thanking Scott Kapnick.
Thanks very much.
Please welcome to the stage Yixin Hung, President and CEO at State Street Investment Management, and John Zito, Co-President at Apollo Asset Management, for a conversation with Bloomberg's Lisa Abramowitz.
I'd like to begin by thanking both Yixin as well as John for being here today for a conversation that will focus on one aspect of the private credit ecosystem that has come under increasing scrutiny, which is retail investors. And I want to start because you two are both combining your efforts to create retail-focused funds, ETFs, that are backed by the credit markets and private credit in particular. Can you just start by saying how complicated this moment has made that effort, based on the fact that seems to be sort of, boogeyman number one?
Well, we got started working together, 3 years ago, before we launched our very first ETF, about a year ago, actually. And because we're such a large ETF issuer, we care so much about liquidity, transparency, efficiency. I mean, that is what the vehicle is all about. And so a lot of that work has been working with Apollo in terms of not only sourcing the investment-grade private credit, but also the intraday liquidity. And one of the most fascinating things is in the course of this year, as we've provided transparency to the underlying, we're finding other parties interested in making a market. And so it's very early days, but I think private credit is not just one big asset class, and we focus really on the investment grade side where it makes sense that liquidity would start to show up.
It's great because it gives us a moment really to differentiate between sub-investment grade credit, which is the tiny slice of the $40 trillion market but gets 95% of the press, and the investment grade side of the...
You'll target it.
Yeah, exactly. To 95% of the business, which is, providing very large investment grade deals for, you name it. We've done 50 transactions in the last 24 months. Intel, BP, Air France, RWE, EDF, multi-billion-dollar transactions that are on, in some cases, 100, 200, 500 billion dollar market cap companies, and it's just a totally different risk profile. And just because it's privately originated or privately structured, it gets put into the same bucket as, you know, sub-investment grade, mezzanine lending in some cases.
I guess that right now there's a fear of what isn't known. And there's a question about why something will get financed in the private markets, which traditionally was a more leveraged finance asset class. Why would it be financed in the private markets when they could have gone to the public markets, right? So what is the value proposition offered to retail investors by going and getting access to private markets?
Yeah, I mean, we're in this unique time where we need multiple trillions of dollars in the US, multiple $1 trillion in Europe, Asia as well. All the AI stuff, spend from power, infrastructure, chips, everything requires a very bespoke, long duration that's not traditional to the CUSIP market. And so if you want to work with somebody and actually commit 10, 15, $20 billion over the next 10, 15 years, you really need insurance and retirement type long duration capital to match with that. And historically, the capital markets was just equity and debt. And the scale and size of the need is so large that you have to access different markets. So it doesn't mean we're only going to do private markets. It means, hey, you may have, you know, AT&T did a pref with us, $2 billion. They have $140 billion of debt. Because they did $2 billion of private debt to diversify, to have a different ecosystem to have access to have a different funding source in times of dislocation, does that mean that that $2 billion of over $100 billion of outstanding debt is risky? Yeah, exactly. So it's like, it is, I joke internally, unless, you know, Claude and AI figured out a way to make private credit riskier in some way, in like some way that I missed or something, or that it made credit junior to equity. I haven't figured that out yet, but if it figured it out, I guess that's a different type of risk, but I don't think that's happening anytime soon.
Well, Ishan, from the perspective of the retail investor, what then is the value proposition if it's the same debt, just in a different name, right? I mean, is it traditionally it offered more yield? Does it still have to?
I think it still does. And if you look at, we've now, are in the process, we've launched 2, we have another one that's coming. And it's a combination of public and private debt, so it's not 100% private credit. And in many respects, the use cases are actually quite a number for both institutional investors as well as retail investors. And in fact, our very first ETF, it really competes in sort of the investment grade core plus category. And if you think about plus, most investors or most managers have delivered either high yield or emerging markets debt as that plus piece. Whereas in this case, we're really talking about that yield premium you get in the private markets. And so you've seen it over the course of the year in terms of the relative performance of this vehicle. And so it does give investors, retail investors, some exposure to an asset class they might not otherwise get, but it also makes sense for institutions. You know, that it is an alternative way of delivering that sort of exposure. And if they're sitting on cash ready, waiting to put that to work, this is a good place to be housing those assets.
So if I were listening to what you guys were saying, I'm like, what is this about cockroaches and people doing dumb stuff? You can go up here, well, it's a typical instrument tied to AT&T. I mean, what do you make of the discussion around what we're seeing in non-investment grade debt, potentially debt tied to software, potentially debt that was underwriting with less stringent standards than you may like to see? I mean, what do you see unfolding right now in private markets? How would you characterize it?
Yeah, I mean, in our product, we do zero. It's 100% investment grade. So it's the reason we're focused on the investment grade side is really what we've partnered on has been none of what's been in the press, but still gets put into the private credit bucket. We've been, you know, I got into credit to actually be out of the press and actually to be a pretty boring business, and apparently it is the most exciting business on the planet.
I'm sorry.
Doing senior lending against large companies is apparently extremely exciting. So we have to talk about it a bit more than I expected. Clearly, we're going through a technology cycle and a platform shift in the world that and people typically don't like change. And so when you go through a platform shift in the way that most businesses are going to operate and most things, there's going to be some level of disruption. And in this case, clearly the eye of the storm is software. And just like in almost every other cycle, I'd like to say that what I'm saying is new. It's not that new. MLPs had a really hard time in energy crisis. Any sector that goes through a platform shift, if you're overexposed, asset managers in that feel tremendous amounts of pain, and you get exposed on the risk management side. And that's kind of what's happening, I think. It's early days. If the software, if the technology keeps getting better, I suspect it will not just be software, it will be services and other sectors that will get exposed. And one thing that's being missed by the private markets is we're doing stuff in funding the next 10, 15, 20 best companies in the world. Like it's not just all bad. We're funding $10 billion for SpaceX in terms of GPUs. We're funding Intel's fab. We're funding Databricks. Like you talk about the single best companies that are being formed, and there'll be 10, 15 new trillion-dollar companies. Credit is the centerpiece of that. And growth investing is going balance sheet heavy because you need all this infrastructure, manufacturing, robotics. You're going to need so much credit, and all of these growth businesses finance themselves with pure equity their whole life. And so I think the exciting part about it, I mean, again, the negative is obviously what it disrupts, but the exciting thing is that growth investing is going to be a balance sheet heavy business, and credit and private markets is going to be the financier for all these great companies.
I love it. When I talk to equity guys, they're like, oh, the problem is it's becoming asset heavy. And you talk to the credit guys, they're saying the nice thing is they're becoming credit heavy. Yishin, from your perspective, I mean, do you see this as being an isolated kind of MLP-like disruption, the idea that you could see one asset class, one industry affected? Or do you think that this could potentially have the nodes of something a bit more systemic?
You know, I think you have to step back from just private credit, right? I mean, AI is such a transformative technology, and we're seeing it in terms of, impacting different sectors. There's going to be winners and losers, which companies adopt it in a very meaningful way to establish competitive advantage, and which are going to be slow to doing that. And so it's a tougher environment, I think, to be investing. Like John, I think private credit's going to be here for a long time because the needs for debt financing are not going to go away, and it's not clear the banks are going to be in a position to provide that type of lending. But it's a time where diversification really matters a lot, thinking about what are the implications as we move forward. And so, having a broad-based exposure, whether it's in private credit or in equities or whatever sector, is really important.
I've been surprised by the isolation of just private credit. I think there's still a complete misunderstanding of what that represents in the economy, meaning 8,000 private companies, broadly diversified. Obviously, some asset managers more than others, but if the private credit market goes through, as UBS said, a 15% default rate, the idea that the public high yield market, the public equity market, all these public markets would be completely fine while the entire private debt market melts, the likelihood of that is extremely, extremely low. And it's been interesting to see how the public markets will say that this will have a very big problem, but everything else will be fine.
Do you reject that type of assessment by Matt Mish over at UBS?
Listen, I think if you read the piece, it was a little bit taken out of context. I think it was kind of his severe bear case, and there's some probability that that can happen. And again, anybody can go out and say that the tail looks like this, and it could. But to say that it will only happen there and that we shouldn't be worried about all these other markets when in fact we're senior debt on all these other markets, again, not really logic behind that, but for whatever reason, it's definitely the story of the day.
Well, there are two ways to look at this. The first way to look at this is that people are overly penalizing private debt and saying that there is an overemphasis on underwriting standards that are weak, et cetera, and that there'll be just a right sizing, and you'll see some of those marks come back if the marks ever were there. On the flip side, you could take a look at this and say, actually, people aren't recognizing that there is deep pain to be had, that this washout is going to be much deeper, and it is going to be representative of a larger credit cycle throughout all asset classes. Where do you sit on that?
Again, I am more in the camp that the next 12 to 18 months are going to probably be more difficult. There'll be more dispersion. And again, when we're going through a platform shift at the core foundation of how things operate, it's, again, that's a really difficult time typically for many companies. Not all companies, but many companies. And so the way to protect from that is be diversified, be senior, be income oriented. So I think a lot of the things that represent why people get into private credit, which is to de-risk, be safer, go senior, it's kind of getting lost with the fact that obviously 30% of that market was software oriented and is really center of the storm. So I'm probably more of the camp that we have a tough 12, 18 months ahead of us. But there'll be clear dispersion coming, and so it'll be interesting to see.
I think we're going to see a lot of signals from the public markets, frankly, because these same issues, whether AI is going to, really impact the software business, any other sector, I mean, that's going to be coming through as investors are worried about the impact on different companies. So I'm sort of with John. I mean, I don't think of private credit as being like by itself. It's part of a broader ecosystem. And I still think we're early days. I mean, there's different theses around, okay, what's the impact? I mean, some software companies may argue that they've got really enterprise integrated models that are incredibly important. The data is valuable. And so where this ultimately settles out, I think time will tell. As we think about different sectors that look like in 2026, we're going to see an ROI from AI is probably healthcare technology or manufacturing, energy discovery, but it's not broad brushed. I think there's a lot of companies obviously embracing it, but then figuring out where does that really move the lever in terms of returns or risks, I think are still to be played out.
This morning on Bloomberg Surveillance, we were talking about how there are these three major risks right now that seem to be buffeting markets. On one hand, you have the question of AI transformation. On the other hand, you've got questions of these pockets of risks that are emerging in private credit. Yes, private credit, but also particularly tied to software and particularly tied to a couple of specific funds. And then you have this third thing thrown in the mix over the past 5 days, which is an oil price shock, which could potentially increase inflation risks, reduce the chance of the Fed cutting rates. At what point does a tightening in financial conditions tied to that type of exogenous shock sort of preempt, escalate, accelerate any kind of credit cycle that you see coming through the pike as a result of the fact, A, we haven't had one in a long time, and B, the fact that there is going to be a lot of change, and people don't like change?
Yeah, I think the question is going to be sustainability of what's going on the last 5 days. The longer it goes, the more it will be priced into markets, but for now it's been somewhat mute in terms of long end. In AI transformation, I think the big question is not whether or not it will make people more efficient. It will be how efficient does it make people, how efficient does it really make people, and what will happen to the labor market in that, and what really happens to the consumer on the back of that, because that has been the big pivot. You've seen some pretty severe headlines from a change in the forward labor market. That I think that's really the big question for markets and how strong the consumer holds up. We're coming into this with $30 trillion of home equity. So it's a very different backdrop than 2008. So pretty strong in terms of overall balance sheet. But clearly, I think consumer confidence is in the early to mid innings of actually slowing. And I think that will probably start to show up in the numbers on a go-forward basis.
Yeah. I think, time will tell, right? I think the market's reacting to every headline as it comes across, trying to read how long is this conflict going to last? And the longer it does last, the impact to oil production and energy transport could translate in terms of higher inflation or longer period of time. But our view still remains that it's a K-shaped economy here in the U.S. and that the lower income populations is where you're seeing lower wage growth, increased delinquencies, unaffordability. And so we still believe that, the Fed should be in a position to be cutting rates rather than hiking rates. But it may take longer for that cycle to begin as we see what plays out.
Given all of the potential shocks, we were just speaking with Talon Pillay of Temasek, and he was saying, for about a decade, they had an illiquidity premium. They wanted to be involved in private markets. And recently, because of all of the shifts, they've said that there's a liquidity premium. I'd be curious what you think about that, given the fact that retail investors tend to look for that liquidity premium, right? I mean, that's the reason why they're going into private markets through an ETF. I mean, do you see there as being a dissonance right now between retail investors' appetites and the reality of a pretty complicated world?
Well, I think the environment we've been in has shifted quite a bit, right? That's an understatement. I mean, fundamentally, you have so much value creation happening in the private markets. If you think about companies with 100 million more of revenue, 85% of them are private. And so you look at overall individual portfolios and allocations to alternatives, whether it's private credit, private equity, real estate, is very low single digits. On the other hand, institutional investors have had very large allocations. And depending on your horizon, right, there's logic for these assets to be within individual portfolios. Now, I think this is where asset allocation comes into play, right? And we think it's a good thing that model portfolios have been growing, thinking about where does private markets belong within a portfolio. It should not be in that sleeve, which is your liquidity need. It should be fulfilled by other parts of that portfolio. So it's an evolution, I think. Longer term, still bullish on the asset class. But at the same time, I think it's really important that individuals, especially those that are thinking about these asset classes, are thinking about where's the right context for them.
I mean, we've set up our business because we invest half our balance sheet with our own balance sheet, and we don't say put $1 in private and put $1 in public. We just say put $2 in credit. And the markets between private and public are moving so quickly. The ability to actually asset allocate from the outside without being able to assess, okay, are the private markets better today versus the public markets, or where should this private asset price based on this public markets? The whole industry has been built siloed. And we're trying to bring that back together where it's just, okay, invest in the best credit assets that generate the best income orientation and the best risk reward, and not make it about private or public. And that, I think we're still in the early innings of that, but the market structure, the asset management structure, the product design, the delivery mechanisms, all of those things are going down a path of much more asset class focused and private public agnostic. And again, that's a big change, but I feel like this is forcing it. It's forcing all of this to become one.
Do you think that the Blue Owl issues and of late the Blackstone issues are creating a challenge for creating those dual ecosystems of liquidity, given the fact that I believe 25 Blackstone partners contributed $150 million to help with the redemptions of 7.5% of a particular fund?
Yeah, again, you describe them as issues. I don't think they're having issues. I think they're making decisions on how to meet their client needs, and everybody has a different client set and a different view of exactly how they want to approach that, and they did what was in their view the best interest for the client. These products in private markets have historically been built in closed-end and drawdown funds, and now they're in quarterly liquid funds, and you have to have first principles about how you want to treat each client. And so I'm hopeful that this is an experience for all of us to make sure we treat our existing clients as fairly as possible in the moment, but also acknowledging that we don't know what next quarter or the following quarter is going to look like. And so we have to make sure that we treat everybody fairly. But I think going through this, and it happened in the real estate business for a while, going through this I actually think is going to be great for the industry.
Well, hold on a second. And you can answer in 1 second, but I want to press you on something. I know you're like, please don't.
She waited till 2.5 minutes to ask me this question. she waited till the end.
What do you mean by treat fairly?
No, listen, when money's coming in and out, there is always the question of, okay, what's it going to look like next quarter and what's going to happen in the world, and there's lots of variables. For anyone to say they know exactly what the world's going to look like in 3 or 6 months, you have to look forward and say, okay, are we doing what's in the best interest of our clients and the long-term experience of the clients over time, and is it consistent with exactly what we said we would do at the beginning? And all of those, it's just critical that the industry does that. And listen, the people who are really big in this industry have been doing this a really long time, and they're really big for a reason. And so I'm hopeful that this experience, no matter how long it lasts, actually brings more confidence to the industry, at least to the people who behave appropriately.
And I think we already were seeing with these interval funds, BDCs, an increasing move to daily marks, much more transparency. I mean, in many respects, that's what was front of mind for us when we built our products together, was to make sure that that visibility was there for investors. And I think that, you know, some of those aspects that you get in the public markets probably do find their way into some of these vehicles. And perhaps that is, you know, one takeaway from this experience.
My final question is, coming into the year, there was a lot of discussion about how retail appetite for private credit was significant and growing because of certain regulatory backdrops. Has this episode changed that at all?
I mean, I think, look, long term, we need, where retirees are growing at a very fast pace. It's not going to peak. Retirees in the U.S. are not going to peak until, I don't know, depending on your numbers, 2055. So you're going to have more retirees, and the baseline is that retirees are going to want to de-risk, which is historically to go into more income and more credit. And at the same time, you have an AI boom going on where you need $4 trillion of new money that's super long duration that matches exactly with the retirees' expectations and return stream. So the broad high level is highly likely that credit allocations go up. The question is, what's the delivery mechanism? What do people want? Do they want private IG? Do they just want credit? I think that's still getting figured out, but you're going to have to be somewhat, you're going to have high amounts of adaptability to actually win. But I think credit allocations over time are going to go up just by the math.
I think that's right. Demographics would suggest that that is the case.
We're out of time. I have a lot more questions, but thank you so much, Yishin, as well as John-Z. Thank you so much.
Please welcome to the stage Jose Feliciano, co-founder and managing partner at Clearlake Capital Group, and Mahesh Soreddy, global co-head of the Capital Solutions Group, Global Banking and Markets at Goldman Sachs, for a conversation with Bloomberg's Davide Scigliuzzo.
This one.
Good morning, everyone.
Good morning.
Morning. Jose, thank you
Afternoon
for being
almost,
here.
Yeah.
As I was preparing for this, Jose, I want to start with you. I noticed that Clearlake is turning 20 this year. For the vast majority of that time, you've been mostly a private equity firm. Then last year, you made 2 acquisitions to kind of increase your presence in credit. How is that integration going? How are you thinking about sort of that side of the business, given all the kind of concerns around credit and private credit in particular right now?
Yeah, of course. Again, good morning. I'm very happy to be here. Thank you, Bloomberg. So yeah, we're almost no longer teenagers. We're going to get to that 20-year mark. What's interesting about Clearlake is from the very beginning, the premise of Clearlake was built upon this idea that kind of the capital markets are more of a spectrum, a continuum, right? Rather than this strong delineation between equity and credit. So we always, even though we have private equity funds, and that has been our core product over the past almost 20 years, we have always had a credit component. But certainly in the past few years, the world has changed, right? The world of alternatives has changed quite a bit. And with essentially the growth of not only credit, but private credit, and hybrids along the way, we think the world looks a little bit different. So short version is that we think that the winners of tomorrow need to have broader conversations, deeper conversations with their clients. And those conversations need to encompass different solutions, bespoke solutions, credit, private equity, and everything in between. And the acquisitions of Pathway and MB Credit clearly position us to kind of be a more global firm, but also more interestingly a firm that can have those conversations across multiple products, multiple segments, secondaries, infrastructure, credit, private equity, et cetera, et cetera. So we think we're well positioned. But again, this is just the second decade, so looking forward to what's to come.
And to many more, obviously, but are there other areas that you would be interested in expanding into that maybe right now you don't have a strong?
Yeah, it's interesting.
You look out a few years.
with this, I think we have a toehold in pretty much all the significant parts of the market that we are interested in. But clearly, there's a lot more to do. When you look at the market, we'll talk about it probably today, but you look at private equity and the way it has evolved, and then you think about the secondaries market, a very small part of the private equity commitments really trade in that secondary market, right? And that's changing dramatically, and you can see that, kind of exploding in a positive way, meaning, massive growth for that secondaries volume.
Yeah. Mahesh, I want to bring you in with this because it's been, obviously there's been a ton of consolidation in the asset management industry. We've seen a lot of firms that expanded from the roots into equity into other markets, and liquid fixed income managers getting into private markets.
Yeah.
How far along are we in sort of that process, and how much more consolidation would you expect to see sort of across that space?
Yeah, again, to the point that Jose made, right, I think one of the things that we continue to notice is the differentiation between public and private markets continues to compress, right? So it's happening from both sides. When we think of issuers, when you think of our clients who are looking to raise capital, they are more comfortable now than, say, 10, 20 years ago around a desire to look at both the markets, both solutions when it comes to kind of, how are they going to raise capital. And the same thing we are seeing on the investing side. On the investing side, we are seeing kind of sponsors expanding from monoline PE shops to like a much more diversified alts shops. Money managers like BlackRock, PIMCO, who are kind of more in the liquid public security management business, kind of getting more into, with the acquisitions that they've made, getting more into the private market. So I think we are still in the early stages of some of this consolidation that's happening. So I think our expectation is the industry will continue to evolve. I think we've seen some, but I think there is a lot more that has to happen because longer term, the winners will really be the ones who have a very diversified platform that can serve the entirety of the capital structure. So we think that's the direction of travel, and we'll continue to see more of that.
Yeah. And I want to get to that point about secondaries, but first to stay on sort of the traditional private equity for a minute.
Yeah.
It's been a tough environment for a while in terms of fundraising. Do you think there is a sort of resetting of expectations for that industry and what returns look like, what fund sizes look like, what deal sizes look like?
The answer is maybe, strong maybe. We have seen this before, right? Private equity has gone through different periods where, compared to specifically the public market benchmarks, private equity returns have potentially lagged, right? And oftentimes, by the way, those are the best times, the best vintages to actually invest and deploy capital. Mm-hmm. Most investors, it's a strong temptation. We look in the rearview mirror, and then we extrapolate. Oftentimes the world is different, right? And instead of moving in a nice smooth curve or line, you have step functions and sometimes jagged edges, kind of to return. So I think, as always, though, private equity, what we have done well in the industry, if you look back at the past 20 plus years, is reinvent the industry every decade or so, right? Kind of what started out as really levered buyouts with a very heavy financial engineering component has transformed over the past 2-3 decades into being real stewards of companies, kind of implementing real governance, implementing real operational improvements. And the laws of gravity haven't changed, right? Kind of, are interest rates higher than they were, 5 years ago? Of course they are. Is the economy perhaps going to be a little slower, maybe driven by significant disruption coming from sectors like technology, energy, AI, of course, being kind of a big overriding factor right now that we're talking about, of course. But at the end of the day, our job remains the same. We buy companies, we try to make them better, hopefully bigger, hopefully accelerate that growth, hopefully in the process making them more strategic, more essential parts of that ecosystem. And if we do that, maybe not tomorrow, maybe not in 6 months, but I'm pretty sure that over a 5 to 10 year period, there will be strategic buyers, there will be other financial buyers, there will be continuation fund vehicle opportunities, all kinds of ways of exiting that are and we're going to be able to make money. Can I say, hey, we're going to make 5 times our money in every deal? Of course not, right? In a higher interest rate environment, do you think that on average, returns in private equity will be somewhat lower? Of course they will. But I think the opportunity in private equity remains the same. There's always an opportunity for good owners, particularly those that can add operational expertise to make companies bigger and better. And if you can do that, you will be able to be profitable and make great returns in private equity.
What's your take? Is there a question of having a bit of patience?
I think the only point I would add there is obviously it's a point in time question, right? Like if you look at what's happening right now, there's 3.8 trillion to 4 trillion of like assets that have been sitting in PE, PE funds for call it like 6 to 7 years, right? It's 30,000 plus companies. So there's always a tendency for markets to overreact to both sides, when things happen, right? When PE returns were really good, everyone was like, PE is the best thing in the world, we're going to invest heavily in it. Now, over the last couple of years, obviously when DPI has been lower, when some of the exits, again, a lot of this is vintages, kind of 5 to 6 year ago vintages, exits have been a little bit slower. I think the market will probably tend to overreact a little bit to the other side. Is this kind of the the phase where PE the PE shops will have a tougher time? I don't think so. I'm with Jose on this in terms of like longer term. I think there is a need for that type of capital in the market. I think people will change the way they underwrite, right? Because if you look at the exits through public markets have gone down dramatically, right? The IPO market, again, obviously we're nowhere near what we saw in 2021 in terms of 400 plus billion that was raised in through the IPO market. This year maybe we'll touch 200. So as the IPO market is demanding a different type of companies to kind of be in the public domain. So I think as investors underwrite and the assumptions they make around exits, the assumptions they make around like, the returns that they want, they might change a little bit as we kind of go through this transition.
Is that just on valuation or debt levels or,
I actually think on debt levels, it's not a problem. If anything, again, I'm sure we'll go into the private credit space at that point, but the availability of debt is as good as it's been. We can, of course, the last 1 to 3 weeks felt a little bit different, but if we take a longer horizon, I think getting debt actually continues to be fairly available.
Easy part.
Yeah, it's the easy part, right? It's really the exits. It's really the volatility around the exits, right? Like you underwrite to a base model, but if that doesn't happen, then how much cushion do you want to leave and what are the returns you want to make? So those assumptions will get tweaked and the return expectations might be higher. But point in time actually is a great, if you have a secondaries fund, it is a very interesting and exciting investment opportunity.
Yeah.
Right? So I think, I do think, again, some assumptions might change, but on a longer horizon, this industry will continue to kind of tweak assumptions, but still be a very, very profitable business.
Yeah. And Jose, how are you thinking about exits in this environment? You mentioned continuation funds that have become incredibly popular. I think they've been gradually more accepted by LPs as well. There's different versions, multi-asset, single asset. How are you thinking about that space?
Yeah. Well, maybe as a continuation of what I mentioned before, our job is to buy these companies, make them bigger and better, and then exit the companies. And there are multiple ways of doing that. People oftentimes say, well, the preferred way of exiting is XYZ. Well, the preferred way of exiting for us is whoever pays the highest multiple, whoever pays the highest price, whatever generates the highest return to our investors. At different times of the cycle, that may be different. And there are times in the cycle, particularly with some companies where strategics are more active. Oftentimes, financial players are more active. And sometimes the IPO market or equivalents, right? Kind of we saw SPACs, for example, for a while, had a little bit of a renaissance, and then they retreated a little bit. Continuation vehicles, to me, is just another private exit. Here, you're substituting maybe perhaps, instead of another sponsor, you're substituting perhaps a group of secondaries players, right, that are leading that transaction, and then with the help of maybe rollover capital or even, kind of existing funds. I think it is a legitimate way of exiting, particularly the way we did it. Our version, our flavor of continuation funds, or at least our aspiration was to do that with kind of the best of the best companies that we were confident that we wanted to own for an additional kind of phase of growth, where that continuation vehicle could be a catalyst for that growth, meaning that that additional capital could be used for acquisitions or whatever was pertinent for that company, and then obviously ultimately get to an exit. And we have done that, kind of partially, and in some cases, kind of totally. But I think you have to look at it on a deal-by-deal basis. It's no different than private equity. There will be some continuation funds and some companies that are great candidates for continuation funds, and some that perhaps are not. And you have to look at it on a company-by-company basis.
Right. And we've seen a couple situations where maybe that hasn't worked out, but it doesn't kind of detract from the idea that
if you're taking risk, by definition, not 100% of everything's going to work out. At least I've been in this business for a long time, have now a little bit of gray hair, and that's my experience.
I have more than you, so you're still doing fine.
I don't have any hair, so I don't know if we should be.
I was just at a conference in Las Vegas, structured finance event. There was a lot of talk about sort of solving for some of these issues that maybe are temporary, whether it be fundraising or liquidity or even returns with structured products like CFOs, rated feeders, and all of that. Mahesh, I'm curious to getting your perspective on like what kind of conversations you're having with clients on that front, and what's that kind of like the new frontier of that of those type of products.
Yeah, definitely. So I would say, when we speak to clients, right, there is a continued evolution of the industry, right? It started with kind of you start doing NAV loans on your positions as a way to like do a DPI. Or by the way, NAV loans started when the leveraged finance market was shut down for a little while. So instead of taking a company by company, you start doing portfolio, you did NAV loans. That was kind of one way, one innovation that happened probably like 3 or 4 years ago. Rated feeders, CFOs, I think all of these, the way I think of it is a little bit more of different ways in which you can get capital into the private markets, right? So these are all, these are all kind of instruments, especially some of these are very well suited for insurance companies, right? Yeah. So as insurance becomes much bigger player in the alts portfolios, they are getting financially savvy in terms of the investments they want to make. So the result of that is the evolution of all these products, and we are seeing continued growth. If you look at kind of the total quantum across all of these types of capital raise that has happened across rated feeders and CFOs, I think that continues to grow. Our projections are that that will be another tool that will be available, especially as we said, the presence of insurance companies in alts portfolios grows. So we expect our clients, and we are seeing again as with anything, right? When something new happens, some clients are very hesitant to use, some clients are very open to use, but over a longer horizon, I think adaptation, if the product is successful, will be there. But right now we're in that phase of like education as opposed to like fully adapted when it comes to some of these products.
Right. Does it feel like it's a bit of a temporary solution to maybe plug a gap until an exit, or do you expect this to become something that's just embedded in how these markets work?
Again, obviously, I've been around these financing structurings for so long. You go back in time when people started doing capital call financing, right? People started doing just kind of like, borrowing against you.
So basic now.
Yeah. At that point, I remember a lot of debate around like, is this financial innovation or is this something that will be adapted by everyone? And today, that's a $1 trillion+ market, right? That's just like so my view is, some products will become like that. Some products will at some point kind of fade out. But I think more of these, I think in my mind, will probably some things that will exist for a longer time.
Yeah. We've had a lot of conversations at this event about sort of where the capital is going to come from. You mentioned insurance and that interest in private markets. Jose, I'm interested in getting your thoughts on the sort of retail side of the picture. There's a lot of discussion about giving retail investors, including all the way into 401ks, kind of access to private markets, whether it be private equity or private credit.
Yeah.
Is that a good idea? As someone who runs a private equity and credit firm now, how do you think about that?
Sure. Perhaps the natural instinct for people on my side of the table is to say, yes, of course, any new source of capital is good. I think we have to be very careful when we talk about this, because first of all, to me, it all starts with we have to be client-driven, right? Kind of what are clients looking for? What is it that they want? What is it that they need and want, right? This is not like medicine that we're giving it to them because it's good for them, but they don't really want it. I think, so we have seen a massive evolution in the retail markets, and those have evolved, right? Kind of traditionally private equity funds, for example, have been offered for a long time, in the large private wealth, kind of ultra high net worth networks. We're talking about a much broader democratization, right? I think my own view is that some of the products that are going to be most suitable for that retail market may not be pure play private equity products, at least not initially. There's also an educational component that comes with it. But I think there's some products that, of course, certain flavors of credit, very well suited for the retail market. Secondaries, again, flavors of the secondaries, it could be really well suited. Infrastructure, perhaps. Even private equity, maybe kind of in a different package, in a different flavor. I think we need to be very careful about how to communicate. Things like liquidity, duration, all those type of things need to be very clearly delineated for that retail investor. So I think it's great, kind of to be able to do that. I think alternative products do belong in a diversified portfolio, kind of in the context of that retail market, particularly as you get to kind of larger portfolios or higher net worth individuals. But we just have to be very careful how we do that. We have to be very careful that we meet that demand from that client, but also communicate very clearly, the risks and benefits of those products. But I think it's here to stay, and it's certainly a growing market and one that we're paying real attention. And in some ways, our acquisition of Pathway was a little bit thinking about that product, not today, but thinking about the demand for products in the next 5 to 10 years.
Down the line. Mahesh, we're seeing a lot of kind of discussion around private credit and that push into retail maybe as the precursor of a bigger push across private markets. What do you make of the situation we're in right now, and particularly with the structure of some of these funds? We heard yesterday a lot of commentary around this 5% cap on redemptions. That's a feature, not a bug. Yet a lot of funds are kind of allowing more than that to be redeemed. Is that kind of mixing the message in any way? What's your sense of what ultimately investors understand?
Yeah, I'd say, if you got to take a step back and look at the evolution of the private credit market, right? Like the private credit market really evolved post the global financial crisis, right? When banks wanted to do less and less of leveraged lending, that's kind of one of the first steps where a lot of these private credit players emerged. And what is the core thesis of doing a private credit loan? The core thesis really was you can go to the broadly syndicated market and you can get kind of a standardized documentation with like a spread, or you can do more bilateral in a smaller space, but where you are kind of doing a bilateral transaction with a smaller set of people and you're getting paid a risk premium, but in return for that risk premium, you are selling liquidity, right? So the core premise of the starting of what the private credit industry was, you can do something where you can get a premium around versus the public markets, right? Even today, if you do a private credit loan, you are getting a premium versus the public market. But in return, by definition, right, like nothing is free in the world. So in return, you are willing to sell the liquidity option because on a longer horizon, you're betting on the credit, not the short-term volatility of the spreads.
But I guess the question is then, is the push into retail then undermining that?
I think that goes to the point that Jose made, and I truly believe in, is it's all about education, right? I think again, I know one of my colleagues made this comment yesterday around, I truly think it's actually, if you want to protect the investors, the LPs who in this case happen to be retail, a fire sale of a private assets is not the way to do it, right? So this 5% cap, actually, what does it ensure? It ensures that there is an orderly liquidation that actually gets the risk premium that you paid for capture, right? So I think there is a little bit of a confusing messages sometimes around, at the extreme, if private credit is traded on a daily basis, then that's public credit, right? So we just need to kind of be a little bit clear on our messaging is, if we have more and more retail coming into all these private markets, I think the expectations have to continue to be set around the liquidity is what you're selling, but to get the higher risk premium. And I think sometimes that gets lost when you kind of do these quarterly liquidities, and I think that's what's causing a little bit of, we saw this in the commercial real estate space about 2 years ago, right? Kind of a similar trend. So this is, I think that is exactly what's happening today. But I think, again, as I said, it's all about messaging to the audience.
I want to touch on sort of software and AI. We've seen a lot of concerns in that space and disruption. If you look at the public markets, I know Clearlake is a big investor in software as an industry. So I'm curious, Jose, what are you seeing from your seat?
Yeah. Well, of course, the past 45 days, the market has really come to this realization, kind of that, hey, software, the business of software, the model might change, right? And the markets reacted very negatively because it adds uncertainty in a part of of our economy, right? That historically, or for the past 15 plus years, has been seen as kind of the growth engine and a fairly clear, secular growth path. And now AI kind of brings that to a big question mark. Like we have been talking about, the markets overreact sometimes. I think the reality is that there will be some software businesses that are extremely vulnerable to AI threats, kind of both from a software development perspective, but kind of go-to-market perspective. If you are kind of a tool that sits, kind of on top of data provided by others, you're going to be very vulnerable. There's going to be some companies that are AI native, right? that are incorporating everything that we know about AI today, and kind of in the future, those companies are going to be very valuable, and there will be several probably trillion-dollar companies, right, that are created from that. There's a fat middle, as I call it, of companies, software businesses that are extremely good businesses. Their growth profile may change a little bit. The way they develop software may change a little bit. But the reality is that they are embedded in their ecosystem. They have the customer relationships. They perhaps have the nexus between suppliers or different parts of the ecosystem. And AI may become just a much more efficient way of developing that software, right? And it's interesting to note that in software, right, not always the best product wins, by the way. And AI today, at the very least, can accelerate that software development dramatically, right? You can go from a team that was like 20 people that would develop a product over 6 to 12 months. Now you can do that maybe with a team of 5 people over 2 weeks. That's dramatic. But at the end of the day, you need to have the customer relationships. You need to understand the business process around that. And the incumbents are going to have an inherent advantage. Whether or not you should pay 20, 25 times EBITDA, or 20 times revenue, or 10 times revenue, or 5 times revenue, that is a really interesting question. But the reality is that it's a target-rich environment today because there's a lot of that uncertainty, and people that understand software understand, this type of evolution like us, where we have invested over 20 years in a broad range of companies, some that are growing very fast and some that are growing more slowly. There's going to be a lot of opportunities there.
Yeah, Mahesh, how easy it is to underwrite deals for software companies right now, and to kind of figure out in which bucket they fit. I'm going to blend in some of the questions we got from the audience here, but the pace of transformation is so rapid that how can you be sure which companies will be a good bet and which ones won't be?
Yeah, I would say, again, I think it's not, software is definitely the flavor of the last 3 weeks, right? But it's not just a software issue. Like from an underwriting perspective, right? What's happening with AI is a transformational thing that's happening that's going to impact many other industries, right? Today it's software, and there's a lot of discussion. Tomorrow it'll be in some consumer businesses where there's, commercial receivables. There's a lot of places where I feel the disruption of AI is going to happen. So it is very challenging to underwrite. And some cases actually will be where there'll be a massive beneficiary of the AI wave, especially data, right? As anywhere where you have access to data, anywhere where you have proprietary data, that's the places where benefit from AI. And some places will have a massive tailwinds from AI. So from an underwriting perspective, I would say this is as complicated as it has been, because this big unknown of what you assume is kind of AI proof is rapidly transforming, could be an AI proof, or what you assume could benefit from AI might not. But having said all that, I think, again, not all software is the same. Exactly the point is, there is a lot of differentiation in terms of if you have a vertical software integrated company, that's much different. So we do have, we do have a lot of clients that are asking a lot of questions around segments that they are very familiar with, segments that they think they'll benefit. But again, I want to keep going back to the point. It's not just software. It's other industries that are getting disrupted that will get a lot more attention. So underwriting overall is because we are into a world for the next 6, 12, 24 months, there's going to be a lot of unknowns. So it is going to be a challenging time to underwrite things.
You said it's as difficult as it gets, but to what extent is that sort of really preventing deals from happening? Like if you can't figure out the answer immediately, does that mean that deal?
I think the way it will manifest itself over time is in terms of risk premiums, right? Because our clients will then want anything. We are seeing that in real time where anything where there is some delta around the outcomes, the risk premium that clients are asking are going to increase, right? For a long time, credit curves were pretty flat. Right, you didn't get rewarded too much for going out in credit or going out to equity, right? And that's kind of what we are seeing. If you look at, kind of again, single name stock vol is higher than what it used to be because the market is saying that underwriting single names is going to be more challenging than what it's been, and credit curves will continue to steepen out.
Yeah.
By the way, quick comment. I think that's interesting to us because the dispersion of returns is going to be higher.
Yeah.
So better stock pickers, people that understand the industry and the company well, are going to do better. We think we're well positioned there. Number two, I see some comments from the audience about LLM's reasoning. They're not quite there yet. LLMs basically are based on data. So whoever controls the data has a better sense of capturing the rents derived from that data. You know, and the LLMs right now are basically capturing really interesting correlations and relationships in that data that are not obvious to mere humans, but they're not quite reasoning just yet.
All right, we're out of time, but I can't show my face in Europe without asking Jose about Chelsea.
Wow, I thought I was going to do a panel about Chelsea.
Obviously, it's been a bit of a rough ride. The club reported a big loss, but sometimes you have to spend a lot of money to make a lot of money. I'm just curious, where are you sort of along that path, and how are you seeing that?
Well, we just won 2 trophies last year, so kind of it depends a rough patch for whom. Arsenal hasn't won in 20 years that I have checked. Or maybe they won something, but anyway, so we just won 2 trophies. We're in the fight for the Champions League this year. The reason that we have to end this panel is that there's a match in an hour or so.
Hard stop.
I think very simple, right? First of all, if you own a sports team or club, you have to understand that you're a steward of something much broader, and the impact in the community is much broader than just a business or just a sport. Second of all, kind of we take very seriously that kind of Chelsea has been a top 6 in the Premier League, and we intend to not only stay there, but we intend to compete for trophies every year. We intend to win the Premier League someday soon. And I think the reality is that I think we have put in place a much more sustainable system in terms of players, in terms of kind of development, that I think is yielding results right now. So we're excited about the season. It's a very tough league, the toughest league in the world. We're fighting to be that top 4 or 5 with kind of names like Liverpool, Villa, United, and I think we're going to do well. But it's sports, so everybody has an opinion.
And you both have been good sport. Thank you very much. Please join me in thanking Jose and Mahesh for their time.
Thank you for hosting. Thank you.
Please welcome to the stage Sean Edwards, Chief Technology Officer at Bloomberg.
It's kind of funny because my brother's a diehard Tottenham fan. I'm sure we can all agree that generative AI is having a profound impact on our industry, and it's a change that I've seen happen faster than anything I've seen in my career. And of course, this is all because of the models, the underlying generative AI. These models are fantastic. right? These models have incredible properties. They understand a broad set of knowledge about the world. They have incredible language understanding. You can do translations and summarizations. But the thing I'm most excited about is that they can reason. For the first time, we have systems that we can give a goal to. It can create a plan, and if you give it the capability, it can carry out that plan autonomously. This changes everything. This reasoning capability is in what is powering new capabilities that we just couldn't build before. And we're seeing this in many, many different fields, including in finance. But for all of its strengths, it's actually hard to use generative AI to build trustworthy systems. And what I mean by that is to build a system that gives you consistently accurate answers over and over again. Systems that you could use to make mission-critical decisions in something like finance or medicine. And the problem lies in the fact that the models themselves don't have a ground truth. We have to give it the ground truth, okay? And what is that ground truth? That is, for Bloomberg, it is our massive amounts of structured data that we have been collecting and cleaning and aligning or generating ourselves. It's the high-quality curated documents that we have been sourcing from high-value sources and creating metadata around it. It's the analytics that our customers have trusted for years. Things like evaluated bond pricing or a segment KPI prediction for a company based on observations of alternative data like credit card spend or foot traffic and aligning it towards what the financial professionals are looking for. It's the portfolio risk models. It is the liquidity analysis that goes into it. So how do we make sure, the challenge actually is how do you use the reasoning power to make sure that these models don't use their world knowledge, but instead only uses the trusted sources of information. These models want to be very helpful. When it can't find an answer, it's more than willing to make things up, okay? And so there's a lot of effort and a lot of research we have done to make sure that you're guiding it in the right way. And without getting too geeky and technical, it essentially comes down to, I'm simplifying it tremendously. My AI team would be upset with me, but essentially is you have to give it the ability to check its work at every single step, at every layer in the stack. What does this mean? This means that you have to build domain-specific checks. Often, these are our deterministic systems. Did you call that calculator with the right parameters in the right order? When you summarized a paragraph, did you faithfully ensure that all the information content came strictly from that paragraph and you didn't insert anything? These validators, these checks, are something that you just keep growing and building, and they are domain-specific, so you have to have the knowledge about what is right and what's not. So at Bloomberg, we build systems that are robust, comprehensive, and are accurate consistently. So for generative AI systems, that means we need to derive our answers from trusted sources. We have to check our work at every step, and we need to provide the transparency and the attribution to the users through it all, okay? Now, we have taken these principles into account when we build AskB. AskB is a revolutionary rethinking of the Bloomberg Terminal. It is a chat interface that allows a user to ask their high-level thematic question. The AI system goes and reaches into a whole network of distributed agents that operate on those trusted sources of information, and then it synthesizes an answer. This is a profoundly different way of building software for ourselves, no longer building screens and thousands of screens and having customers have to know the mnemonics, but it's also a profoundly effective way for customers to be able to derive insights that they would have missed or they wouldn't have seen. And as we go forward, we're adding more and more asset classes, more and more analytics, more and more capabilities so that the system becomes more powerful. But all along the way, it has to be built in a trustworthy fashion. So I highly encourage you to go look outside. There's a demo booth to look at AskB. And whenever you're looking at systems, do the evaluations. Spend the time to look at the quality. It's really easy to get excited about shiny demos. It's really hard to build trustworthy AI. Thank you.
Bankruptcies. There will always be bankruptcies. There are thousands of credits in the marketplace.
You see one cockroach, there are probably more. And so everyone should be forewarned on this one.
Stage, Bruce Richards, founder, chairman, and CEO at Marathon Asset Management, for a conversation with Bloomberg's Matt Miller.
All right, thanks very much. I'm really pleased to be here with Bruce Richards from Marathon Asset Management. He doesn't really need an introduction, but I will say I've been interviewing Bruce for at least a decade now, and he is the first person that I heard make this call on software being essentially endangered by AI, and that private credit was overexposed to software. It was over a year ago. And so I'm glad to be able to talk to you, Bruce, about that now, because this morning you put out a LinkedIn post saying, maybe we can draw some parallels between what happened to energy in the mid-2010s and what's going to happen with software now. At that time, we had a 20% plus default rate for energy credits, and you think that we could go to 15% for highly leveraged software companies. Help us unpack that call.
So when you draw that parallel, I'll talk about the call in a second. When you draw that parallel, it's a difficult parallel to draw because oil and gas has nothing to do with software at a certain level. And any rating agency or industry practitioner would know that. In fact, the man in the street would know that. But here's where I see not the trees, but from up above, 1,000 feet down, looking beyond, the actual parallels that are strikingly similar that our viewing audience should understand. So number one, there's a major technological change that changed forever oil and gas. And it's called horizontal drilling or fracking, where you used to go down vertically, and now you can go down horizontally. And what it did is it completely changed the pricing structure for oil and gas. And with all the leveraged companies in the high yield market, in the broadly syndicated loan market that had that exposure, all of a sudden, when the pricing structure got crushed, all of a sudden, all the capital dried up. And you had, after that 2014 and 15 excess of drilling and all the financing required to support all that drilling, in 2016 and 17 and 18, you had back-to-back years of 15% default rates because of three things: the technological change, the change with respect to capital availability, and the pricing structure of the underlying commodity itself. And so as you draw that parallel to software, you have the same thing. You have this massive technological change called AI. It's going to affect the pricing structure, which is ARR, right? And capital is now drying up. Who will finance these companies going forward? And so I see those parallels. So when you go to the public equity market, there's no leverage really. You look at NASDAQ, S&P 500, the Russell 2000, look at the software companies in these industries, they have 0.5 turns of leverage, half of a turn of leverage. Not much leverage at all. You go to broadly syndicated loan market, 5.2 turns of leverage for a software company. Because when you come to the broadly syndicated loan market, the rating agencies and investors have discipline. They say no more than 6 turns of leverage, or we can't let that loan go into a CLO, or if it does go into CLO, it's going to have a much lower credit rating. So where do all the highly leveraged broadly syndicated loans go to, or I should say direct loans go to? They go to the private credit market of direct lending, where they're 8, 9, 10 times leverage on software companies. And so what that leads you to is this. The public companies have really nice margins, generating free cash flow, and can defend the fort. In other words, creative destruction can make them a better company in an AI world. They have a really good fighting chance to do so. If you're 10 times leveraged or 8 times leveraged or even 6 times leveraged, then all your cash flow is going to debt service. You have no cash flow, no free cash flow to be able to reposition the company, make the investment you need to make to transition to an AI-first software business. So I think the default rates, now that the bed's been laid and there's no out, in the years 27 and 28, when a lot of these 20 and 21 and 22 deals come due, loans are 5 and 7 year loans. When these loans come due, there's no refinance capital available. And so there's a very big parallel, and I'm calling for a 15% default rate. I can't tell you if it's year 2027 or 2028, but it's coming, and it's unequivocally coming because the valuations have been reset lower, and anyone that's a lender today should be lending at 4 turns debt to EBITDA, not 6, not 10, and they should be getting paid a higher rate because it's a uncertain business to lend on.
By the way, before I get into why private credit has so much exposure here, what do you think of the public companies that have been crushed because of this narrative, but maybe aren't going to have their lunch eaten by AI?
I think there's some good value there.
Yeah.
And so you see the software industry itself has bottomed a couple weeks ago in terms of, or in the last couple weeks, in terms of valuation after a big trade-off. And so they're actually up off the lows. And those companies aren't levered, but also have to deal with transition. So on some of those companies, you're going to see, significantly higher prices because of the creative destruction will allow those companies to be transformed into an AI-first software. And some of those companies actually won't make it, and you'll see some losses. But you have all the upside, if you're buying an index of it, to offset your downside. And so I'm actually neutral to slightly constructive now on software. I'm not saying we've seen the bottom, but I think that I'm not so bearish now in the public equity markets for software because there's been this massive adjustment. We don't know who the winners or losers are yet, so it's hard to pick single names. But for an overall industry, I think there's been a massive adjustment, which offsets some of the uncertainty. In the broadly syndicated loan market, software names are off year to date around 11 to 12 points. And they're 5.2 times leveraged. So then you have to say to yourself, okay, if a broadly syndicated loan is off 11 to 12 points, then how much should a direct lending loan be if it has much more leverage to similar type companies? Less than 10, 11 points? About 10, 11 points? Or substantially more? I'm not going to answer that, but I think everyone has their own conclusion on that.
Why is private credit so exposed? And by the way, when we ask on my show, I anchor Bloomberg's Open Interest every weekday from 9 to 11.
Great show.
When we ask, most of the fund operators say, that's everybody else, right? We're not exposed.
So everyone's rearranging the furniture right now. Yeah. It's like rearranging the chairs on the deck, right? As the saying goes. And that's software company. Oh, it's a healthcare company. That's software company. Oh, that's travel and leisure. That's software company. That's an education company. No, they may support healthcare or education or travel and leisure. They're software companies. And so everyone's trying to re-rate or recategorize what the exposure is to say, I don't have that much software exposure. The simple fact is there's 3 numbers to remember: 3, 13, and 23. 3% of the high yield market is software. 13% of the broadly syndicated loan market is software. 23% of the direct lending loan marketplace is software. And so it has that exposure, regardless of where you want to put the chair on the deck. It has that exposure, 23%. Now, some managers have 26% or 32%. Some of them have 15%. Different managers had different, investment discipline. But why do you have 23% in that one industry sector when only 1% of private companies are software companies in this country? I don't know. I don't have an answer for you. We have 1% exposure to software, and it's a 4 turns debt to EBITDA, loan. So I can't tell you why it's 23%, other than it was a big gold rush. Everyone had convinced themselves that you can finance and put a lot of money out the door by financing a software company because they had nice margins and presumably good growth rates. Most of those growth rates haven't panned out, though. And so now you just have a much highly valued company, too highly valued company, with too much debt on it. And that's going through a technological transformation with a pricing transformation that we've yet to see, but is undoubtedly coming as you pay per seat or you pay per token, or the pricing structure starts to change.
So what happens now to private markets? And everybody's, especially this conference, talking about yesterday, Mark Rowan said, we're due for a correction in private markets. But obviously there are different businesses. Private equity is very different from private credit.
Yeah. So I think private markets are actually in pretty good shape. I think there's some pain out there. If you have a cockroach in your portfolio, people are going to want a company that committed fraud. That's an issue. I think that's very idiosyncratic and very rare. But
you're not worried about the tricolors, the first brands, the MFS?
I'm not worried about that being systemic at all. It's not like liar loans on the subprime housing market back during the GFC that polluted the banks. The banks don't have this exposure. It's not that broad. It's very, very isolated. There will undoubtedly be more as people start to put the microscope on all these companies and bring religion back to how they lend, and lend in a much more disciplined way. And so number one. Number two, I think away from software, because I think capital's really not available to lend to software companies right now today in the private markets, other than the current lender wanting to amend and extend their loans, pick that loan, but the new money coming in isn't going to come in at more than 4 or 5 turns of leverage, because that's where a highly leveraged company should be financed. And software is inherently a riskier business today, and so it should be financed not only with that lower leverage, but with a higher spread, because you have greater risk given the uncertainty. As it relates to the rest of the economy for now is doing pretty well. Our natural growth rate here in the United States is 1.8%, and we're growing at a faster rate than that. We'll have to see how oil prices are going to impact that, but holding all things constant from what we know from the start of the year, $30 trillion GDP here in the United States. You grow at 2% a year, that's $600 billion a year. I had penciled in we're going to grow at $1 trillion this year. Much more, because the reindustrialization of America, because bringing the supply chain back, because of everything that's going on with data centers and building out those data centers, as well as the economy. We talk about the consumer being a K-shaped consumer. It's an E-shaped. Economy starts with the letter E, not with K. And the middle class, that big line in the E, is a pretty big cohort.
By the way, this is an important point that you're making, Bruce, and because it isn't what we hear every day on my show. People talk about the K-shaped economy all the time, the idea that the wealthiest, the top 10% are powering more than half of the economy, and that the lowest 50% is having a real problem. We see, I think we lost 70 or 80,000 manufacturing jobs in 2025, so I don't see the reindustrialization happening.
But let me just tell you, the E-economy, and I'm talking capital E on economy. And there's that 10-20% at the upper end that owns assets, that have good credit scores, that power a lot of the spending. Got it? Check. And there's a lower 40% of the cohorts that have poor credit scores and are indebted and struggle and don't have much assets, certainly on a net basis after debt. But the middle 40% is the middle part of the E, and let me tell you about the middle part of the E. Wages have risen sufficiently high, with inflation having softened just a little bit, although it's ticking up now with energy. But it's the first time in years that wages have risen above inflation, so they've actually had a chance to accumulate wealth. And the average middle class in that 40% has $250,000 of net worth, so $500,000 of assets, with $250,000 of debt for $250,000 of net worth, with a savings rate that's starting to improve marginally. And that part of the economy is actually doing well. And so we talk about the K because we talk about extremes. That's politics for you, and that's, you know, people, you know, glamorizing the, you know, the extremes. But there's a real E in the middle that people forget about that also powers the economy. It's a big part of this. It's not only the K-shaped economy for consumers that is an E. The K-shaped economy is also for companies. Growth companies versus companies that struggle, but there's a big middle class there of companies that do just fine, that represent mid-market companies. And so if you look at, you know, the, you know, Mag 7 this year, it's down a few percent on the year. Well, if you look at materials and industrials and energy companies, they're up 25% in the year. And so there's a big middle class of companies that we also think represents the economy. And we think with the economy doing fine in terms of growth, A, B, the big tax receipts coming in because of OBBA, you know, and what it means for, you know, an average taxpayer getting back $1,000 in the middle class, more than they had. It's more discretionary money, more savings. And so I think the consumer for now is fine. The big delta, the big change is oil. And I've run my internal model, and it's really instructive for markets, and I think for how we should think about it, if you want to hear it.
So I do, because you have talked to me before about you believe manufacturing is coming back to this economy, and you're bullish the economy, as we just heard. Now, with the war in Iran, we are seeing, you know, Brent crude spike from mid-60s to low 80s, and inflation is going to limit the amount of cuts the Fed can act on. I mean, how is that going to affect the economy and your outlook?
It's big. It's big. And so the key here is duration. Duration of how long this lasts and what's going on in the Strait. So let me frame it for you. 100 million barrels of oil get produced every year in this world, every day in this world. 100 million. And 20 million come through the Strait. And pretty soon, Qatar is going to have to shut off their oil and gas, more importantly, their gas manufacturing and production. And it's going to take a week to 2 weeks to shut it down. It'll take a week to 2 weeks to fire it back up, because if you can't ship it out on these big LNG tankers, then where can you put it? And they're starting to get to that point where can you put it? And that's true of oil, it's true of gas. And so Henry Hub in the United States has gone up 5% since the war began 4 days ago, but in South Korea it's went up 75%, the price of gas. And the price of gas is up 50 to 60% in Europe, because you're very dependent on these shipping lanes. And so you got to be very careful what it means. So here's my model, and here's what you need to think about. $60 oil, we grow at 3% in the United States. I think it's a lock. I think it's probably, you know, the surprise is going to be the upside of that in terms of the growth expectations I have for this year. Take oil up $20. That's your magic number. It's for every dollar, but like I'll extrapolate for you. Take it up $20 to $80. I think growth rate goes to 8, from 3% to 2%. So you take 1% off at $80 oil. Now let's go to $100 oil. You're at 1% growth. Let's shave off 1%. 1% growth, which means you have not only inflation, as you mentioned, but lower economic activity. I'm calling that stagflation. You take oil, not for a spike, but sustain it there at $120 an oil, a barrel for oil, $120 for Brent, you're at zero growth. That's the trigger for a recession, $120 a barrel. That's what I believe, and I believe that's what the markets believe, although no one said it yet. That's a very simple model, and let's lock that in. $100 is 1% growth, 120, and the president knows this. And they want the war to be short, be over in a few weeks, to get that Strait open, to get oil pumping again, to get the economies of the world back on track, and having solved this problem that the U.S. has and that the West has with Iran. And if he can pull that off, that's legendary. If he can't pull that off, it's going to take much longer in terms of duration to stretch on for a really long time. Then that's really a problem because it's going to eat into economic growth. And that changes the whole equation for what you expect in terms of, growth and financing and equity markets, and because it very much drives valuations.
Bruce, I'm seeing red flashes here, so I know that we're out of time, but I do want to get to the acronym that you coined on our television program this morning, which is HALO.
HALO.
This is, I guess, depending what happens in Iran, obviously, your investment thesis right now, and it stands for hard assets, low obsolescence. How do you come to that and expand on it?
Yeah, so, I mean, in asset-based lending, when you lend against aircraft or engines or cranes or turbines, and you have $300 million of collateral and you have a perfected interest in it, and you're making a $200 million loan, you have a $100 million margin of safety, and it's a mission critical asset to the company. So when we take engines and we lease them to Delta Airlines, that's a great credit. That's a great operator. And we're making a nice return because we secured these assets. It's hard assets, low obsolescence. Okay? And when you think about direct lending as well, the opposite of hard assets and low obsolescence is software.
And there's no software names that you like, by the way. There's, in terms of the debt, right? There's nothing that's fallen far enough that you're bargain hunting.
I think the shoe for financing has dropped, but I don't think the other shoe has fallen in terms of defaults and defining who the winners and losers are. It's too early to tell that. But I do know that they don't have free cash flow after debt service, most of these companies, and it's going to be very hard for them to reposition. And so the public companies are going to be the winners in that space, not necessarily the private equity companies. But again, private equity has all the upside, and so they're so good at what they do that they'll figure out how to reposition a lot of these companies to get those much higher multiples that can offset some of that downside. But back to direct lending, if you have a direct lending loan to a company that does, I don't know, sprinkler systems for commercial buildings or concrete with rebar, that's going to help power the reindustrialization of America, that's a very stable business to be in. And so we like those type of businesses, hard assets, hard to replicate, real economy assets that we can lend against, either their operating businesses when doing direct loans or hard asset lending when we're doing ABL.
Bruce, always a pleasure. Thank you so much for joining us.
Thank you, Matt.
Bruce Richards from Marathon Asset Management. Show, Bloomberg Open Interest, weekdays from 9 a.m. to 11 a.m. Thanks.
The world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every Wednesday at noon Eastern, only on Bloomberg Television.
Please welcome to the stage Scott Nuttall, co-CEO at KKR, for a special simulcast of Bloomberg Deals with Danny Berger.
Thank you all so much for joining for this special edition of Bloomberg Deals here at
And we're good.
Scott, thanks to you as well for helping close out this excellent conference.
Thank you, Danny, for having me. Hi, everybody.
So as this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment, because we entered 2025 saying this was the year of private capital reemerging, of animal spirits, of deal making, and then April 2nd happens. It feels like we did the same thing over again in 2026, and then it's AI, credit fears, and now war to contend with. Scott, can 2026 still be the year of M&A, of deals, of private capital's year?
I think it can be. You're right. There's a bit of a deja vu element going on. We came into last year and this year with expectations capital markets would be strong, M&A environment would be robust, and it was last year for larger transactions. A lot of what we do, the $1 to $10 billion deals, was less robust. I think people were waiting a little bit to get into this year to start to sell some of their companies. It still could be the case that that's available. This is a moment in time. We'll see how long we're here. It's far too early to call. As you know, the tariff concern last year lasted for a couple months, and the people processed it and started to move on. We'll see how long this lasts. This could have more duration to it, though.
Well, what happens if it does have more duration? And I should just say that KKR has been out in front with monetizations, but the industry as a whole is still experiencing that indigestion. What happens if it continues?
Well, I think you got to step back. The way we look at it is you got to go back in history a little bit, right? So we came out of the financial crisis as an alternative asset management industry. The whole space was roughly $3 trillion. Right, so we've seen growth now from $3 trillion, and that's excluding hedge funds, to about 15 from the course of 2010 to 2025. Okay, that sounds like a lot of growth, but it's about 11, 12% a year. And so we went through this period of time, 2010 through 2020, pretty benign environment, right? Rates were low, inflation was low, multiples were going up. We said to our firm, do not confuse a bull market with brains. Right? We saw a lot of growth during that period of time. And you're right, 2020 to 25, pandemic, wars, inflation, rates up, tariffs. Very different period of time. And so what's starting to happen is you're starting to see the decisions that people made over the last 5 to 10 years become more clear in terms of whether those were good decisions. Our industry periodically over-deploys. And that's what happened in 2021. People put a lot of money to work in 2021. And so to some extent what's happening now, and some of the noise I think you're hearing in the market, is some of those deals are now getting to their 5-year mark. They've got to refinance their capital structures. But not everybody's painted with the same brush. You know, this is a very US-centric dialogue so far.
Sure.
You know, for us, we have more than half of our investment professionals outside the United States. Right? We have learned these lessons, and I can say this with a lot of humility. We made the over-deployment mistake as a firm in 2006 and 2007. And so we learned, you got to be focused on linear deployment. It sounds boring, but if you have 5 years to invest money, do about 20% per year. It's a very low-tech chart to see how you're tracking. Don't over-deploy, don't under-deploy. Got to focus on portfolio construction, and critically, you got to be diversified. And there's nothing that kind of beats those three things. And what we found, I thought it used to just be my teenage sons, but it turns out everybody's an experiential learner. You know, people learn by doing. We learned these lessons a long time ago, and so I think where we're heading now is, you know, we've talked about K-shaped economy all the time. I think we're headed toward a K-shaped industry, where you're going to see a bunch of winners and some folks that have more lessons that they have to learn as they come out of this period of time.
But is everyone going to be like KKR, learn the lesson and go on, or is it a shakeout that's going to happen in this industry?
Far too soon to answer your question.
Okay.
I think there's going to be some consolidation. As sure as we're sitting here, there's some firms that will not be around. There's some firms that will do the apology tour and the apology fund. So the next fund will be 0.3 times the size of the last fund, but their investors will decide to give them another chance. How that breaks down, far too early to tell.
Is it a problem then, and I don't want to get into the complexities of war, but one of the outcomes of it might be higher inflation if energy prices go up. It did seem like kicking the can down the road might have been solved if we could have a meaningful rate cut cycle. If we don't get that, how does that change the industry and the ability of those that are currently learning the lesson to survive?
Well, I think we will see what will happen, and we're already hearing it from our limited partners and institutional investors in particular. They are consolidating their relationships with people that have been giving them money back and people that have been performing on a relative basis. We did spend better part of 10 to 15 years a little frustrated because we felt that we were making better decisions in terms of through cycle investing. That was not apparent when rising tide is lifting all boats. It is now far more apparent today than it was even a few years ago, and a few years from now will be even that much more the case, hence this K-shaped comment. So I think what's going to happen is you're just going to see increasing dispersion in results, and not everybody's going to be painted with the same brush. So for example, in January, we sold a software company for 4.5 times our money. On Monday, we did a block trade in the public markets for one of our public names in the US. We have multiple businesses all across Asia. It was a very active monetization year for us in Asia last year. the benefits of being global and diversified and being thoughtful about deployment pacing through cycle investing and portfolio construction are going to really matter. And then there's going to be the have-not bucket. And we'll see. We'll see how people learn. We'll see if their investors are prepared to give them a chance to come out of it. And so over time, some of those will do well, as we talked about, and some may not be around.
By the way, I mean, underlying all this, and this is kind of where we started, it feels like there are 4 simultaneous existential shocks and risks happening right now, whether it be how AI transforms our world, fears over credit, trade fears continue to crop up, and it's now war too. What is an investment committee like at KKR right now? There must just be so many risks that you're having to grapple with.
We're very calm. I think we're actually enjoying this period. Okay, so you got to focus on what you can control. Markets, actually, let's go back, further back. Human beings, and therefore markets, hate uncertainty, right? It's absolutely the case. And it's also the case that a number of people, most people that are investing seats for a long while, have PTSD from the financial crisis. And so everybody's trying to figure out what's going to trigger the next big downfall for the space, for you name it, for the economy, for the markets. We don't see a precondition for that as we sit here today.
By the way, so just meaning you would disagree with the Jamie Dimon comment, it looks like pre-2008 sort of environment.
It's who knows? You need a lot of humility. That's not my job.
Sure.
Right? Our job is to invest for the long term and generate returns for the people that are counting on us. We need to think in 10, 15-year increments, right? So the investments we're making today, the companies we're financing today, people that refinance us out of those or buy those assets from us, they're going to be looking at years 10 and beyond. And when you kind of think in that way, oddly enough, it's easier to kind of get your head around what's year 10 look like than what week 10 looks like. And so what happens when you have volatility, it tends to be great for our business. And this is where people get a little confused. If you're a public market investor, because you invest, you think we do the same thing. It's a very different business. We have 118 billion of dry powder, right? And as we say to our teams, if you have 118 billion of cash in your pocket and nobody can take it away from you, when things get cheaper, that's called a good day, right? So to some extent, you kind of almost root for things to kind of get more reasonably valued, and then you can make some great investments. These tend to be very attractive vintage years for us, but I think we need to be really sober-minded about what's happening right now. S&P 500 is flat year to date.
Yeah.
It's up 18% last 12 months. Europe is up 6% year to date as we sit here. Asia's up 8%, even with the correction that we've seen in the last couple days. So it's not like the markets have traded off, and credit is just shrugging this whole thing off so far. And that's what we tend to watch more than equities.
Well, are you surprised about that at all? That markets seem to be shrugging things off?
I think people are trying to assess, what does this really mean for the long term? And you have a challenge, right? Where's the money going to go? There's a lot of liquidity in the system. And so to the extent you'd asked me a week ago if we were going to invade Iran, or bomb Iran, what is that actually going to do to the markets? I'm sure most of us in this room would have been wrong. But in terms of how people are thinking about the long term, it is what it is. But for us, the equity market, we tend to think of as the more emotional friend you have that's a little Chicken Little in nature. And the credit market is the more sober-minded friend. When this friend gets nervous, that's when we get more nervous. We're watching this kind of move up, down, sideways so far. It's too soon to know.
I mean, that's one side, that there hasn't been a lot of reaction. Where the reaction has been is every single headline around private credit, whether it be redemptions picking up or just readership and viewership interest. We certainly see that on Bloomberg. Are you surprised about that reaction, about the reaction to private credit that just feels like there's so many eyeballs and such a microscope on it right now?
Well, it's a little bit to my PTSD from the financial crisis comment.
Yeah.
I think people are just looking for what is the next thing that is going to trigger something bad. And so I'm not surprised that it's getting focus. But also, let's keep in mind, right, the global capital markets are $300 trillion, about 50-50 debt equity. Fixed income's $150 trillion market. Direct lending, so when people say private credit, they're really talking direct lending, is $1.7 trillion of the 150. And so it's roughly 1%, a little bit more than 1% of the fixed income market. And then within that, this isn't a return thing. To get a fund down from an 8% return to 6%, you need to have a lot of defaults and very poor recoveries. And if you have that dynamic, I promise the last problem you're going to have is your private credit return being 5 or 6% versus 8%. You're going to have equities off a lot. You're going to have other issues in your portfolio. So it's less about returns. As ever, when you get in these moments, it's more a question of liquidity. And that's what people are anxious about.
Is that a fair anxiety to have about liquidity at this moment?
We don't see it. I mean, I think the vehicles themselves, forget whether the structure of these kind of private BDCs is going to work for the long term. That's not really the question. I think people know that it's private markets. It's actually in the name. When the reason that you tend to have issues with the markets more broadly is you've got leverage on top of leverage in the system, duration mismatch across wide swaths of assets that get revealed. From what we see so far today, that's not the case, but there's a lot we don't know. And I think that's what the market's nervous about, back to the anxiety and uncertainty. And in the public markets, people sell first and ask questions second. And so we're kind of in this moment where people are nervous, and people that are nervous or panicking, they don't listen that well, and they're not often great at math in that moment. And so we're kind of in that moment in time right now. It's too early to call. Let's see.
Is it a problem, though, if fundamentals are sound, but you have this technical issue of redemptions and outflows? In other words, does something that become technical, is there a risk that it spills over to become a fundamental problem?
It would be, man-made in that instance, I would think. Sure. I think if people want to, kind of be very anxious and the markets more broadly trade off, could you come up with a scenario there's a wealth effect? But you would need such a big move in the markets. And I think one of the things we're seeing, there hasn't been a lot of new supply created in the capital markets. Part of the reason we haven't seen the credit markets move, there's not a lot of new supply getting created. There's actually supply being removed, and there's a lot of cash in the system. Same thing in equities. So it's a little about where's the money going to go? What else are you going to invest in? And we can sit on cash, sure. But in terms of if you want exposure to risk assets, people are looking at the market thus far as clearly and saying, okay, despite all the noise, this is pretty isolated. Software, AI, private credit, non-traded BDCs, very, very small part of the overall market in aggregate. The rest of the market's shrugging it off.
By the way, that idea that there's capital that needs to be put to work and there's limited supply, that's been pointed to as saying both credit and equity markets are mispriced. Would you agree to that as well? You're a close observer of credit markets, that there has been a little bit of skewing of valuations just because of the demand and lack of supply?
Oh, there's no question in credit in particular, spreads have been tight. Right there, it's back to the point. There's been capital, formation, but not enough product being created to absorb it. And so I think in the long term, I think we might look back on this period of time and saying this is healthy. This is a healthy rebalancing in terms of kind of spreads may move out a little bit. We'll see. Hasn't happened yet.
Right.
But if they move out a little bit, it'll be more back to where they were. Because remember, we're at kind of near all-time highs for most asset classes and more near all-time tights in credit spreads. And so people forget, not that long ago, last year the S&P went from 5,800 to 4,800. Now we're at 68, 6,900. A year later, the markets have moved up a lot. And when you have 3 years, we were talking about this morning with our partners, when you have 3 years in a row of 15+% return for the S&P, the next 5 years are pretty anemic in terms of equity returns. And you usually have a down year. We've had a great run in the equity markets and same in the credit markets. So taking a little air out of the balloon wouldn't be so bad. And for people looking to deploy capital, back to my point, volatility creates opportunity. So it's all about being ready.
Where's that opportunity right now? I know COVID, for example, when the market was frozen, KKR was one of the few that was out there to that point of linear deployment. In the volatility right now, where are you seeing those pockets that look attractive?
It hasn't really shown up in size as of yet. So you're right. COVID, we were doing daily partner calls because we wanted to be ready. And we put a lot of money to work. But there was literally a 1 or 2 week period where the leveraged loan markets globally were on sale. And then it all came back. So you've got to be ready in the moment. You can't say, I'm going to go study this for 3-4 weeks. It's probably going to be gone by then. So we haven't gone to daily partner calls yet.
Right.
But we're getting close to weekly. So we're moving, but it's all about being ready. And so what you got to do is you got to create your shopping lists. That's what we're focused on. If something gaps out enough, where do we want to buy so that you can move fast? That's our work right now.
Can we have a peek into your shopping list?
Nope.
What might be on it?
Nope, I'll tell you after the fact. How's that?
Okay, fair enough. Come on Bloomberg Deals and tell us when it does happen. One purchase that we know you did is of Arctos. Can you just walk us through the thinking on that? Sports, secondaries, what was the moment that you decided these are capabilities that we want to add onto our platform?
Sure. Well, really, it comes down to people. I mean, we're in a people business, right? It's just the marriage of capital and talent. And so we have known Ian Charles, the founder, for a long time, decade plus. Liked him a lot. Did a deal with him, actually, secondary sale off our balance sheet. That's how we met. And, you know, sometimes you meet somebody and say, wow, really capable. You know, would love to have him as part of our team. It was that kind of a moment. Sadly, he worked somewhere else at the time, but he left that place and then started Arctos in 2019. So it really started with that observation. He built this sports business with his partner, Doc O'Connor, and then a GP solutions business alongside. And so we started looking at what they were doing, and because of our relationship, we just were comparing notes. You know, they would call for advice, we'd call them, get their thoughts on the markets, that kind of thing. And it just kind of developed organically from there. We as a firm, the one thing we do not have is a secondaries business. We looked at buying several and decided we couldn't find anybody that fit with us. How's that? So Ian and his team, their background is in secondaries. So the way we looked at it, the sports asset class, highly attractive, not just the franchises themselves, but real estate, securitizing media rights, lots of opportunities around it. GP Solutions, which is providing financing and kind of business building help to firms that own have alternative asset management firms. That, as a business we know well, we've built our firm. And we cover 250 sponsors already through our direct lending and private credit business. So a lot of synergy there. And then they hadn't started building the secondaries business yet. So we looked at it as established business here, and then a big opportunity to build secondaries together. So that's how it happened.
Do you also have a shopping list for other pieces you'd want to add to the platform? Is there a sale among managers as well that, along with Arctos, you'd want to bring into the KKR fold?
M&A is hard in our business. It takes a long time. And for us, you know, it needs to kind of check a number of boxes. Asset class we're probably not already in any great size.
Right.
The team fit and culture fit have to be amazing. That was critical about Arctos, is the cultures are the same. And probably more permanency of capital. What you don't want to do is pay a big multiple for runoff capital that you have to replace. That's hard to find. Arctos, we bought a REIT platform in Japan. We bought our insurance company. So we've spent 13, 14 billion on acquisitions, but they're hard to find that have all of those attributes. So we're always looking, but I wouldn't say there's a long shot.
I say industry-wide because there's been some talk of, are we going to start to see mega mergers? Do you think that consolidation will take in that form and you'll see a really dramatic shrinking of just the number of firms out there?
I think the mega merger between two alternatives firms is very hard.
Right.
You got overlapping LPs. You've got to figure out who's going to run the place. If you have overlapping businesses, probably a decent amount of negative synergies to think about. So I think you'll see more maybe BlackRock type acquisitions of alternatives players, and maybe players in different asset classes get together and create firms that have more diversity and kind of magnitude of overall AUM. But the two big firms getting together, never say never, but it strikes me as unlikely.
Do you think, though, that given what you're talking about, moving to alternative managers, only about a minute here, but that the landscape will just look very different in 5 years' time?
I think we've gone from 3 trillion to 15 trillion during a period of time where it was, for most of that, everything was going your way. I think we are going to see this space continue to adjust. I think, we'll have fewer players 5 to 10 years from now, but I don't think you're going to see a dramatic difference. I think you'll see it around the edges, and you'll see the big continue to get bigger.
All right, Scott, we're going to have to leave it there. Thank you so much for closing us out and joining us today. Everyone, please join me in thanking Scott Nettle of KKR. Thank you to everyone for being here, for being such a great audience. We hope you all enjoyed all of the conversations over the past 2 days. You can head to Bloomberg Live's YouTube channel or to Bloomberg.com if you want to rewatch any of these conversations. I also want to give a quick thank you to our wonderful sponsors over the past 2 days. It is our title sponsor, Invesco and the Qs, QQQ. Our Knowledge sponsor Marsh as well. Our supporting sponsors, Allspring Global Investments, Deutsche Bank Wealth Management, Harborview Equity Partners, Moody's, and Salesforce as well. Very thankful for all of our sponsors. If you don't need to head off, please join us downstairs. We have a lunch. We have a networking lunch downstairs. As a matter of fact, it's out these doors. Make a right. And we adored having you all here. Thank you, and have a wonderful day.
Where you going, my brown-eyed son? You used to crawl, but now you run. You started off on a road half dark, and the river curled into a question mark. We sleep on diamond beaches, dear.